followed by other asset related standards. Anyway, right on it, we'll move on to India 16, which is property, plant and equipment. Standard, as you all know, it's pretty much easy standard, but the basic setup in India 16 will be subsequently useful in India 38, 40 and 41 as well. So coming to the definition part of it, property, plant and equipment is specifically defined as a tangible item of asset. Because once upon a time we used to have this word called as fixed asset. The word fixed asset basically includes tangible as well as intangible assets inside that. But now intangible assets, anyway, we have a separate standard. This standard PP covers only tangible item of assets. And these tangible item of assets must be held for usage only. And usage for what purposes? Production of goods, rendering of services, administrative purposes, or giving on rentals to others. Plus, if you have to get covered under the standard, prima facie should be a capital expenditure. So that means the benefit should be, it's expected to be used for more than one accounting period. That means the benefit of this particular asset should come or accrue to the entity for a period more than 1 year. So prima facie, the last point is only to say that this is going to be a capital expenditure. Then only you come under India 16. Next, there are some scope exclusions and all, which are not much relevant. Only the important one here is biological assets are not covered under this standard because we have a separate standard in India 41. However, if it is a bearer plant, then it is still covered under India 16. Similarly, exploration assets, minerals and all, but these generally accepted accounting principles in the market only are followed by the entity in the absence of any specific standard right now. Even though there is a standard on that, that's presently not applicable for our examinations, which is India's 106. Then PP, which are classified as held for sale as per India's 105, that will see when non-current assets are held for sale standard, that standard covers that. Anyway, now coming to bearer plant. See, bearer plant is a part of biological asset. That means biological asset, if it is a very big, biological asset is a very comprehensive term. In that, bearer plant is a small subset of it. So bearer plants basically means these are normal plants only which have the nature of a plant and machinery. Understand it like something like a mango tree, a coconut tree and all. Now if you observe the characteristics of mango tree, coconut tree and all, do they have life more than 1 year? The answer is yes. Are they capable of giving you agricultural produce for more than 1 year? The answer is yes. Are they held for sale in the ordinary course of business? That means those trees are not grown for with the mere intention of chopping them off and selling them for wood purposes, right? No, definitely no. So that means there are trees which are grown for the purpose of their agricultural produce, and they are capable of giving you agricultural produce for more than 12 months period. So it's just like how a machinery operates. A machinery's life also will be more than 1 year. It is also capable of giving you goods for a period of more than 1 year, and it is not primarily intended for sale in the ordinary course of business. The same 3 points are again given under the definition of bearer plant. So bearer plant must be used in production and supply of agricultural produce, expected to bear produce for a period more than 12 months, and has a remote chance of being sold other than as incidental scrap sale. Of course, once the tree dries up and all, eventually it may be sold off, but prima facie it is not held for the purpose of being sold. That means that there is a very, very remote chance of you selling this tree. This kind of trees are called as bearer plant. So a mango tree, coconut tree are examples of bearer plant. If it is a bearer plant, then it is covered under the scope of India 16. Other biological assets or any other plant which is other than bearer plant is covered under India's 41. So this bearer plant definition we are studying here now because this is covered under the scope of India 16. Now coming to recognition criteria of PP. For that matter, any asset, the recognition criteria will be same. That is, future economic benefits will flow to the entity. For that, probability should be there. So what is the meaning of probability? The chance of happening should be more than 50%. So if it is probable that the future economic benefits associated with this asset will flow to the entity, that means you should believe that there is more than 50% chance that the benefits will come to the entity. That plus the cost can be measured reliably, because in most of the cases, as we will be discussing subsequently, the initial recognition of the item will be done at cost. Since initial recognition is done at cost, if you obviously should need to know the cost, because if you do not know the cost, the entry will be passed with what amount then. So obviously cost has to be known. Now, coming to this first point once again, when you say future economic benefits, what are those future economic benefits? Now, future economic benefits means either increase in revenue or decrease in costs or both, which eventually leads to increase in cash and cash equivalents of the entity. That means when you say future economic benefit, what we are trying to say is either the revenue should increase or the cost should increase, or both can happen, but ultimately the cash and cash equivalents of the entity should eventually increase. That is the meaning of future economic benefits. For example, you buy a plant and machinery is used for production of goods or rendering of services, which will yield us some revenue. Or you buy some kind of equipment, because of that you can remove some 4 or 5 labor people, which is work which is presently manually done. So that is reducing your costs. Sometimes both can happen. And also the standard is pretty clear that the benefits can be direct benefits, like you produce goods, sell the goods, get the benefit, or you decrease your cost, directly enjoy the benefits or savings out of that. Sometimes even indirect benefits are also there. Indirect future economic benefits are also okay. For example, there is an equipment which is held for the purpose of disposal of waste. See, there is some toxic, harmful substance that's getting released in the production process. That toxic material, I cannot throw it anywhere, wherever I want, right? So for that, we have a particular machine. So that machine is used to eliminate the toxins from the scrap that is getting in the process of production. So if you observe directly, it is not contributing anything to our revenue directly. It's not contributing to reduction of cost directly. But because this machine is there, which is eliminating the toxins, this is helping me to effectively dispose the waste that is arising out of production process. Imagine I do not have this machine, then I will be facing a lot of trouble to run this business, because I cannot throw these toxins anywhere in, because they are prima facie harmful. So this kind of indirect benefits are also okay for us. Next thing. Sir, what about major spare parts? Are major spare parts, should they be accounted as property, plant and equipment? You see, major spare parts and major tools and equipment, if their life is more than 1 year, that means they are capable of giving you benefits more than 12 months. That means prima facie they are satisfying the definition of PP. Therefore, they can be capitalized as property, plant and equipment. The small consumables and all, the regular spare parts and all, they are treated as consumables. What is the meaning of treating as consumables? See, in your P&L account, we have something called as cost of materials consumed. So opening stock of some materials plus purchases of this stores and spares during the year minus the closing stock of stores and spares what you have, this net figure is directly booked as an expenditure in your P&L account. So that's what you will do with minor loose tools, stores and spares. Major spares definitely you have to capitalize, provided they satisfy the definition of PP. So all these points regarding future economic benefits are given here. Next, coming to measurement. The initial measurement of a PP depends on how you have acquired the PP. See, a ready-made asset can be acquired by paying cash or or it can be purchased on credit. Or sometimes PPs can be constructed, just self-constructed PP. Sometimes PPs are acquired by exchange of another asset. We acquire PP by giving away some other asset. So depending on which scenario you fall in, accordingly the measurement principle will change. Anyway, when PP is purchased for cash or credit, so imagine there is a ready-made asset that we have bought either by outright payment in cash or within a normal credit period. In this case, what amounts will go into the initial capitalization of PP? Remember, the rule is what? Initial recognition should be done at cost. Now the cost includes what and what? So obviously the purchase price must be included. Any non-refundable taxes should be included. Any trade discount and all, if you have received that, you have to subtract it, right? But do not subtract any cash discount. Cash discount means the supplier gives you a credit period of, let us say, 3 months, and the supplier says that if you pay within 1 month or something, then he'll give you extra 5%. That's called as cash discount. That cash discount should not be reduced from the cost of the asset. But the volume discount or a trade discount which is obtained directly at the time of purchase of the asset, that definitely must be reduced. Now the asset is in some other place. From that place it has to come to our site. So these traveling expenses, loading, unloading charges, freight, transit insurances, all these things can be capitalized. Once the asset reaches our location, it has to be installed. So for that, some site or some foundation has to be prepared. So that site preparation charges, can be capitalized. The installation expenses is basically the cost what we incur for towards labor and other supervision charges to get the asset installed, right? So this cost definitely has to be capitalized, which is the installation expenses. Sometimes during the course of installation, some technical supervision is required, without which these people cannot be able to install the asset. So the technical supervision charges can be capitalized. Then trial run expenses. Once the asset is installed, to know whether it has been successfully installed or not, or to know whether the asset is functioning in its expected condition or not, we need to input some material, some overheads and all we have to incur and see whether the asset is functioning well or not. This is called as trial run expenditure. Trial run expenditure definitely must be capitalized. And during the trial run, if some output comes, that output is sold, so that's an inflow again. That inflow can be reduced from the trial run cost, and the net trial run cost only should be capitalized. Next, if India's 23 borrowing cost standard permits you, then borrowing cost also can be capitalized. Apart from all this, when you buy an asset, if you have any obligation, either because of operation of law, which is a legal obligation, or because of your own conduct of activities, which is a constructive obligation to decommission the asset or to restore the environment at the end of the life of the asset to its normal condition, then apart from all this, you have to also create a provision also towards decommissioning. This means normally PP account debit to bank with all the expenses what you have incurred, which are going to the cost of the asset. Plus you may also have to write PP account debit to a provision liability, provision for decommissioning. So decommissioning liability also might have to be recognized in case you have any legal or constructive obligation. And this decommissioning liability should be recognized at present value. It should be capitalized at present value. Every year what will happen? Every year this present value will be unwinded for discount. That means every year the interest cost you have to incur, you have to book and correspondingly increase the provision for decommissioning liability. Over a period, the decommissioning liability will keep on increasing to its original estimated value at the end of the life of the asset. Subsequently, you are not going to touch the value of the asset with this interest cost and all. So guys, that is all about the initial recognition when asset is purchased for cash or credit. Sometimes the asset is purchased on credit, but it is purchased on deferred settlement terms. Deferred settlement terms means it is not the normal credit period, but you have obtained abnormally large credit period. When normally the credit period you deserve is around, let's say, some 2 months or 3 months. If the supplier is giving you 3 years credit period, the supplier is not a fool. No, obviously the supplier will be losing interest, and that interest he will definitely be charging to you. That means if the supplier says that after 3 years you can pay, but you have to pay 1,20,000 instead of 1 lakh rupees today. That means the extra 20,000 whatever is charging, that's nothing but the interest for the delayed payment. So that interest cannot be forming part of the cost of the asset, because it's a financing cost that has got nothing to do with the asset performance. So whether you pay now or you pay after 3 years, the utility of the asset is not going to change for you. So such interest cannot be capitalized. So in that case, what should I do? So what we will do in that such situations is, see, there are two types, sir. One is, for example, you have obtained an extra credit period of 2 years. The question tells you that you have to pay 1 lakh rupees after 2 years. This is the ultimate payment what you have to do now. Okay. Sometimes the question also gives you the cash price today. Let us take easy numbers. The question tells you that if you pay outright amount right now, it will be 1 lakh, but the supplier has given you extended credit period of 2 years, after which you are going to pay 1,21,000. In that case, what you will do is, if this is the information given to you, you interpolate these two numbers, identify the rate of interest included there. So the entry you will be passing is basically PP account debit to vendor or supplier with an amount of 1 lakh. And on this, every year 10% you have to book interest cost. So every year the entry you will be passing is interest cost account debit to vendor. So that will be 10,000 for the first year. So first year ending vendor liability will be 1,10,000. On that 1,10,000 for the second year you will be booking 11,000 interest. Eventually the vendor liability will become 1,21,000. You pay it off. This is one kind of situations where the question will give you cash price, The question will give you the future payment what you will do, and interest rate they will not give you, you yourself have to work out. In that case, capitalize the asset at cash price. This the question may not give you, this you may have to work out. There is another kind of questions where the information will be somewhat like this. The question tells you that you have to pay 1,21,000 rupees after 2 years. Today cash price the question will not give you, but the question will give you a discounting rate. So what you will do is, you will take this 1,21,000 using this discounting rate, you bring it back, work out the present value and start recognizing it 1 lakh. So the procedure is same, but the requirement of the question can be different. Sometimes they'll give you present value, sometimes the question will give you cash price and also the discounting rate, or this discounting rate 10% they may give, may not give, but cash price when it is given, usually you capitalize that at cash price and do unwinding of discount on the liability part. Sometimes they will not give you cash price, they will only give you the future payment what you have to do, and the discounting rate will be thrown. So use the discounting rate, work out the present value, recognize the asset at that value and continue from there on. So this is another model. So decommission cost I have told you, this part is okay. Next. What we have just now discussed is this one, purchase of asset on deferred settlement terms. Right. Now coming to self-constructed assets. That means you are not buying a ready-made asset, but rather you are constructing or building your own asset. So the only rule you have to remember is all actual costs. Important word is actual. All actual costs must be capitalized. That means indirectly notional cost and all should not be capitalized. All actual costs that are directly attributable to construction of PP must be capitalized. Suppose in the process of construction you incur some expenditure, but that expenditure did not contribute to creation of asset, rather it is a loss. For example, there is a faulty design given. Based on that design, you have incurred some expenditure towards material and labor for a period of 1 week. But after 1 week, you realize that the design was faulty. So last 1 week, whatever expenditure you have incurred, all that is waste only, but that is incurred in the process of construction only. But still, is it contributing to the enhancement of the value of the asset? No. Whatever work you have done, it is waste. You have to again redo it based on correct design. So that means this entire expenditure of last 1 week is an abnormal loss in nature. That abnormal losses cannot be capitalized. Similarly, notional cost cannot be capitalized. What is notional cost? For example, we are a cement manufacturing company. Each bag of cement costs us 400. We are selling it in the market for 600 rupees. Suppose we ourselves are constructing a building in the vicinity of the factory. Now, for the purpose of this construction, I took 1000 bags from my godown and used it for construction of building. So 1000 bags into cost 400, but market price, had I purchased it outside, it would have costed me 600 rupees. So with that idea, you should not be capitalizing 600 rupees. You have to capitalize only the actual cost incurred. Actual cost incurred is 400 rupees. Only 400 rupees into the number of bags utilized in the construction of the building. Only that much. No imputed, no notional cost and all, internal profits and all should not be recognized and capitalized. That is wrong. Next thing, since we are talking about construction of PP, it's quite likely that you will satisfy the definition of qualifying asset. Since you will satisfy the definition of qualifying asset, if you have incurred any borrowing cost and all, that borrowing cost may be capitalized subject to India's 23 requirements. That is borrowing cost standard is there, you will apply that. So this is about self-constructed asset. Next one. Suppose in the course of your construction of building, for example, you are constructing, this is your site. You are constructing your building here. Okay. During the course of this building construction, temporarily some of your premises is given it on rent to somebody, because you will not use the entire space immediately. So you are constructing phase wise. Meanwhile, for a period of 6 months or 1 year, somebody has taken your premises on rent till the construction was happening, and they gave you some rental income. This rental income has got no connection with your construction work. So don't deduct this rental income while determining the total cost of construction. Do not deduct this. Do not deduct this. For example, in the course of this construction, there is some scrap. Waste materials and all will come now. That's scrap. That scrap we sold. So this is also an inflow. But the sale of scrap, excuse me, sale of scrap arising in the process of construction is definitely related to the activity of construction itself. So this can be reduced from the cost of construction, but this cannot be reduced from the cost of construction. So you must be clear with this one. Next one, the most important one. This is PP acquired by exchange of asset. We purchased a PP not by paying cash or not by completely paying cash, but by exchange of another asset. It's a very, very easy case. Let's watch this. So I am having an asset A. This asset A I am giving away, and this asset PQR I am bringing in. Now the question is, this new asset PQR, what I am bringing inside my entity, that should be capitalized at what amount? That's the point we are trying to address. This PQR asset should be capitalized at what amount? So let's take some basic data. Since A is my existing asset, I will be having some carrying amount towards it. Imagine that is 10,000 rupees. If I sell A independently in the market, I will get some amount. Let us say that is 12,000. If I immediately sell PQR in the market, whatever I bought, it may have some fair value. So let us say that will be some 13,000 rupees. PQR will not have any existing carrying amount, of course. Now whatever I write against PQR, that will become its initial recognition amount, and consequently that will become the carrying amount as well. Anyway, the important question you have to catch here is, A is going away, PQR is coming, so A has to be de-recognized, PQR has to be capitalized, right? Right. Second thing, the only question the standard asks is there a commercial substance? Now, what is the meaning of commercial substance? Commercial substance means the cash flows, nature, risk and timing of asset given up and asset acquired are different. That means the nature of cash flows, what I would have earned from A, and the nature of cash flows, what I would get from PQR, if they are different, then we say that there is a commercial substance. Commercial substance is supposed to exist when the configuration of the cash flows from the asset given up and asset acquired are significantly different. Indirectly, the standard says, are they both A and PQR, are they both similar assets or dissimilar assets in terms of the cash flows? It's not about, sir, I gave car, I bought car, so they are similar assets. Not about the nature of the asset per se, but how similar are the, or how dissimilar the assets are in relation to the nature of their cash flows. If you say, sir, they are quite different, sir, if you say that they are quite different, the cash flows are quite different, then we say that there is a commercial substance. And now when you yourself are saying that their assets are quite different in terms of their cash flow, then this newly acquired asset should be recognized at a different value from the value of the asset that is given up. So the value of the asset given up is, carrying amount is 10,000 in our books. So this PQR should not be recognized at 10,000. PQR A is already appearing at 10,000, but PQR should be recognized at a different value. So if you say, if commercial substance exists, then machine PQR to machine A. Machine A must be derecognized, PQR should be recognized. Machine A should be eliminated at 10,000 rupees because it's its existing carrying amount. Machine PQR should be recognized at fair value, the real worth of PQR. Now the question is, so fair value is okay, but fair value of asset given up I should take or fair value of asset acquired I should take. So here first preference, fair value of any asset, or sometimes if you pay asset as well as cash also, in that case fair value of assets given up. If this is not there, then obviously you will go with second preference, which is fair value of asset acquired. Sir, in that case, sir, there will be a gap in the entry because the fair value of PQR is 13,000, fair value of fair value of machine A given is 12,000. So in case I record this amount at 12,000 rupees, or if 12,000 is not there, in which case I will go with this 13,000 rupees. There may be a gap in the entry. Sir, a gap will go to profit and loss account. You say gain or loss, that will definitely go to P&L. So this part is clear. Asset must be de-recognized at its carrying amount. Incoming asset should be recognized at fair value because there is a commercial substance. Fair value of which asset? Fair value of asset given up or assets given up is a first priority. That is not there. Fair value of asset acquired. You have to take entry definitely may not tally. So the gap will go to P&L. So this is when commercial substance exists. Sir, what if commercial substance does not exist, or it exists but fair value cannot be determined? So you know that the assets are quite different in terms of their cash flows. The incoming asset should be recognized at fair value, but fair value could not be reliably measured. So what option do you have? Or when you say that both the assets are almost the same type of cash flows, they are giving same life, same nature of cash flows, there is nothing significantly different. So the standard says when the asset cash flows in future are going to be more or less same, why to change the existing carrying amount of the asset? Whatever existing carrying amount of the asset is there, that only you continue for the incoming asset also. So effectively what will happen in this case is machine PQR to machine A. My skeleton entry basically will be same because one asset has to be gone, another asset has to be recognized. This asset has to die, so it has to be credited with its existing carrying amount. Incoming asset also should be recognized at the same carrying amount in such a way that in this entry no gain or loss. So in a way here what I have written is a balancing figure. What I have recorded there is balancing figure. The incoming asset should be recognized at carrying amount of asset given up in such a way that the gain or loss is zero. There should be no gain, no loss. Sir, what if along with machine A you have paid some cash also, or you have received some cash also? Whatever it is, once there is no commercial substance, you cannot have a gain or loss hitting your P&L. So which means what will happen now is, so if machine PQR to machine A, see machine A I have to eliminate from my books of accounts, so here crediting 10,000 is given, I can't change that. In case I pay cash or I receive cash, some amount, any amount, see both cannot happen, either one will happen. So then this amount will be a balancing figure. This amount will be a balancing figure in such a way that here there is no gain, no loss. So that's all is the story for exchange or PP acquired by exchange of asset. So whether cash is there, not, all that doesn't matter. There is only one question you have to answer, whether commercial substance is there or not there. If there is a commercial substance, you are indirectly saying that the asset acquired and the asset given up are completely different assets in terms of their configuration of the cash flow. Since assets are different, the incoming asset should be recognized at fair value. In that fair value also, preferably the fair value of what we have given up. If you are giving asset also, cash also, then calculate the total value of the cash given plus the fair value of asset given. Total put together, you debit it to the incoming asset, the initial recognition amount. Outgoing asset must be credited only with its carrying amount because it has to be de-recognized. There is every chance that the entry will not tally, so that gap will go off to your P&L. as a gain or loss. This is when commercial substance exists. If commercial substance does not exist, you cannot have a gain or loss hitting your PRL, because the nature of the assets given up and the nature of the asset acquired both are same. So in that case, the incoming asset should be recognized at balancing figure in such a way that gain or loss should not be arising. So guys, that is about your PP acquired by way of exchange of an asset. So this example and all is given. So already asset is there, which is capitalized, on which depreciation you are providing, and all subsequently on that expenditure is incurred. Let's say you have an office building with 4 floors. In the current year you incurred some expenditure, you constructed one more floor on that. So now onwards you have a 5-floor building instead of a 4-floor building. So what is the treatment of this extra expenditure incurred? So always you have to assess, sir, the extra expenditure. If it is resulting into additional future economic benefits in future, then you will capitalize it. In any other case, like for example, some maintenance work, painting work, here and there it is looking not so nice, so you repainted it, or small maintenance repairs and all you do. This kind of expenditures do not warrant to be capitalized. They are directly thrown off into PRL as an expenditure. So this is about subsequent expenditure. Now coming to component accounting, it's a very interesting one, important one as well. Suppose, sir, we purchase an aircraft, let's say for 30 crores. Its life is, now what's the life of an aircraft? Now you see, there is no single life we can specify for aircraft, because this aircraft is an assembly of so many parts and each part has got a different life. So our standard says, identify every major component, determine its life separately, and provide a depreciation for each such major part or component separately. In the balance sheet you may show it as a single asset called as an aircraft, that's okay, but in the internal records we should have detailed accounting for each component. So that is the story of this component accounting. So let's see with a small example. Suppose my aircraft has 2 major parts. Just for convenience I'm splitting like this. One is the engine, the other one is the body of the aircraft. Let's say on fair value basis its worth is 10 crores, its worth is 20 crores. So I know that I spent 30 crores for this. Excuse me. Let's say here life is 5 years, here life for the sake of convenience is 20 years. So here depreciation per annum will be 2 crores per annum. Depreciation is 1 crore per annum. So even though in the balance sheet you show a single asset called aircraft, but internally records should have detailed accounting maintained for engine separately, body separately. Now, suppose you are in 4th year. If you suddenly check your balance sheet, it will appear like this. Originally, the cost is 30 crores. Every year 2 crores here, 1 crore there. Total 3 crores I am providing depreciation. Till now 4 years is over. Minus 12 crore depreciation. The aircraft effectively is appearing at 18 crores in the balance sheet. But since internally we will be maintaining individual accounting, so we should know the breakup of each one of them. So engine will have a carrying amount of 2 crores, because 2 crores into 4 years, 8 crores depreciation I would have provided. Out of 10, 8 is gone, remaining is 2. Coming to the body, it should be 16 crores. Each year 1 crore, so 20 crores, 4 years is over, 20 minus 4 or 16 crores. So this is the internal breakup. Now let's see. At beginning of year 5, company replaced engine with a new one costing 14 crores. Now what is the treatment of this 14 crores? So existing engine they have removed it and they have installed a new engine. Of course, original life is still there, but before the end of its life they did not want to take risk, so they have incurred some 14 crores and removed the existing engine. Now what is the treatment of this 14 crores? Now you see this engine is directly going into the aircraft. It's an integral part of the asset. So 14 crores there is no discussion at all. So directly 14 crores has to be capitalized. But already in your 18 the carrying amount of existing engine is there. So this capitalizing this new engine cost is okay, but you cannot continue with the existing engine carrying amount, so that has to be derecognized. So this 2 is getting derecognized here. This one is getting capitalized here. So at once you are writing an entry something like this. So your PPE, one new engine you are capitalizing with an amount of 14 crores. Your X or your existing engine that you will derecognize it, whose carrying amount is 2. Now what will happen to this difference? If you are able to sell it and all, then you will write bank. If you are not selling it, then you will have to scrap it, then it's a loss. So either bank or PRL, sometimes both, because you will be selling at a gain or a loss. So depending accordingly, this number will be there. So this is a story of component accounting. So whenever a new component is acquired, so the cost of the new component is capitalized, but the carrying amount of the existing component has to be derecognized. Next one, major overhaul or inspection cost. Major overhaul or inspection cost is also something similar to the same component accounting part. See, certain assets like aircrafts, ships and all, these assets legally are supposed to be compulsorily gone for a major inspection once they have traveled a particular once they have traveled for a particular number of years or particular distance. Then these assets like ships and aircraft, they have to be compulsorily checked for any major faults. So this is not a simple inspection. Major inspection means the every part, the hardware parts or the engine parts, everything is checked for turbulence and all. They will be checked whether are they able to withstand the turbulence in the event of a worst weather functionality, whether the instructions are properly being sent to the passengers across the aircraft and all these are hypothetically, they are simulated and they are tested for whether they are able to withstand high levels of pressure situations and all. That means basically a fitness certificate kind of thing is required to be obtained. So this is not a small thing. This entails huge amount of expenditure also. Anyway, let's go with a small example again. Suppose I purchased an aircraft. Same example like earlier, but a little improvisation. So when I buy an aircraft, so now I will split this into 3 parts now. One is the engine of the aircraft. One is the body of the aircraft. The other one is major overhaul or inspection cost. Let's say this is 10 crores. This is 15 crores. This is 5 crores. Earlier example, I ignored inspection cost wantedly because anyway I'm going to cover it right now. Anyway, look at this. So the life of this is 5 years. The life of this for convenience is 15 years. The life of this for convenience again is 5 years. That means let's say for every 5 years I have to incur a major inspection or major overall expenses. Now you may ask me, sir, you spent some amount for purchase of aircraft. So whatever aircraft we are having on our hand is definitely a new one. So once I buy a new aircraft, why the hell will I go and incur major inspection and overhaul cost immediately? Of course I will not incur with my own hands. Why? Because this is bloody new asset. So since it's a brand new asset, why will I incur any inspection cost or overhaul cost? I will not obviously incur. But why are you not incurring? Because it's a new asset. So if it is a new asset, there won't be any faults, sir. There will not be any faults because the seller has already done all the testing and all. That certificate also is attached to the airplane when it is sold to me. So when I know that I am paying 30 crores, I am getting the aircraft per se and also a comfort that I need not incur this cost in the next 5 years. So basically, even though I did not incur this cost and I did not actually incur the expenditure, I know that this 30 crores what I paid is also including a payment for the inspection cost which the seller has done, which I need not do for a period of 5 years. So the benefit of that particular expenditure is only for a period of 5 years. So you have to capitalize that separately even though you did not actually incur that expenditure with your own hands. So in this case, so the depreciation part, here it is 2 crores, here it is 1 crore, and here also it is 1 crore. So every year 4 crores. So let's say I take you directly to balance sheet at the end of year 4. So you may be showing a single aircraft as an asset at some amount, but inside your engine will have a carrying amount of 2 crores, because out of 4 years, every year 2 crores, 8 crores I would have removed it. The aircraft, the physical body of it, let's say it will be at 11 crores, 15 crores cost minus 4 crores depreciation for 4 years, and the overhaul cost we initially identified at 5 crores, every year 1 crore I am removing, so another 1 crore is there. So total 14 crores is there. Let's say during this year, there are a couple of aircrafts which have crashed in the air, because and it is found that they haven't performed well. So government became strict and there was a huge media cry and all. So our entity also thought that let us change our policy. Instead of going for major inspection every 5 years, we should do it only for a 4 years period. And immediately the company has incurred overhauling costs of rupees 8 crores. The moment you incur overhaul costs of an amount of 8 crores, which will give you a kind of protection for the next 4 years, immediately this 8 crores has to be capitalized. So 14 plus 8, it became 22. But what you must not forget is, if you are incurring new overhaul costs now, 1 year before your expected period, that means indirectly you are saying that the benefit of previous overhaul is no more there for you. That means this overhaul cost carrying amount must be de-recognized. Just like component accounting story. So whatever we discussed in component accounting, that applies even for overhaul costs also. So new overhaul costs, when you incur, any existing carrying amount of previous inspection overhaul cost must be de-recognized. Next. Coming to subsequent measurement. Subsequent measurement means you have capitalized the asset, you are providing depreciation and all. Subsequently in the balance sheet, the asset should be appearing at what value. So the standard gives you two choices here. Depending on what choice you select, that will become your accounting policy. The choices are, number one, you can follow cost model. The other one is you can follow revaluation model. Cost model means you will simply provide depreciation. If at all any indicators of impairment are there, and when you do impairment loss also you have to provide. Anyway, basically, even if you forget impairment for a moment, normally every year just have to provide depreciation. That's all. That is called as cost model. But in case you follow revaluation model, then does it mean that the asset will appear at fair value in the balance sheet? Listen, revaluation model ka objective understand first. The objective of revaluation model is, you initially capitalize the asset. You compulsorily have to provide a depreciation. After depreciation, one amount will be there which is called as a carrying amount. This carrying amount and the real market value of the asset, if you sell the asset, between them significant gap should not be there. That is the objective of revaluation model. So initially you purchase the asset, you recognize it 10 lakh rupees, you provided depreciation for first year which is 1 lakh. So now the carrying amount of the asset is 9 lakh rupees. Compare this 9 lakh with the market value of the asset. After comparison, if you feel that the gap is significantly different, the carrying amount and the fair value are different, then you go and do fair valuation. So the objective of revaluation model is to ensure that there is no significant difference between the carrying amount of the asset and the market value of the asset. That is the goal. Sir, no sir, I have the policy of showing my asset every year at fair value only. Fine, no problem. Do fair value every year. Nobody will stop you. Nobody will stop you. But fair value obtaining is not a very easy exercise, no, because the asset what you are having is not a brand new asset, it is a used asset. So like that, it's not just a single asset, you might be having multiple assets in this class. So for everything, if you are following revaluation model, then definitely you have to go and work or fetch the fair values from the market for all the second hand assets what you are having. So that might be a little difficult exercise. So the standard what it says is, in case the fair value fluctuations are significant, that means the fair value of the asset is fluctuating highly, in that case we will not take risk, we will revalue the asset every year. But in case the fair value fluctuations are not that significant, that means the fair values are normally only there is no huge high, huge down like your real estate properties in India. There is no heavy fluctuation. There is no heavy fluctuation. The standard says it is enough for us if you do revaluation once in every 3 to 5 years. If you do revaluation once in every 3 to 5 years, that is also okay. So in revaluation, must understand one thing. Following revaluation model does not mean that you will not provide a depreciation. You have to compulsorily provide a depreciation. After providing depreciation, you can fair value the asset if the gap between the carrying amount after depreciation and the fair value is significantly different. If they are not different, sir, I don't want to do fair valuation. Don't do. You are still following revaluation model only. Revaluation model does not mean that you will not provide depreciation. It also does not mean that every year compulsorily you have to do fair valuation. And revaluation model also does not 100% ensure that the carrying amount and the market fair value should be exactly same. It need not be same. Even small differences can be there. So understand the objective of the standard. Sir, next one. Sir, I have so many assets in my balance sheet. For some assets, can I follow cost model? For some assets, can I follow revaluation model? Can I do that? The answer is the choice of cost model and revaluation model has to be applied for each class of assets and not for individual assets. For example, you are having 4 buildings, office buildings. So for 4 buildings, since all the building nature and usage is same, definitely for all these 4 buildings, you should have a uniform policy, either cost model or revaluation model. Plant and machinery is there. There are 3 plant and machineries you are having. Since building and plant and machinery falls in different class, when you come to plant and machinery, again you will get a choice of either following a cost model or a revaluation model. It is like that. But again, you see, I have a couple of buildings which are office buildings and I have another 2 buildings which are factory buildings. So total 4 buildings I have. Even though I have 4 buildings, the buildings' nature and usage are different. These 2 are for factory purpose where production and all will happen. Office buildings where head office, admin buildings, board meetings and all, its headquarter buildings are there. So one is for administrative purpose, the other one is for production of goods. Even though both are buildings only, their nature and usage are not at all same. So they belong to different class. So office buildings can have a choice, either cost model or revaluation model. Factory building, again I'll get a choice of cost model or revaluation model. So sometimes this, even though name is building only, it can still fall in different classes also. Next, how will you do presentation of revaluation? This is also a good one. So let's see this. Suppose, sir, you have an asset whose original cost is 1000, on which already accumulated depreciation provided is 600. That's a total depreciation till date. So presently in the balance sheet, asset is appearing at 400 rupees. The fair value of the asset is 800 rupees now. Since we are following revaluation model, from my 400 rupees carrying amount, I have to jump to 800 rupees. Now, how will I ensure that the asset in the balance sheet is appearing at 800 rupees? See, normally when we say asset is upward revalued record, so immediately we'll write the entry asset account debit to revaluation surplus. Entry per se is not wrong when you do it in normal questions and all. But when the question gives you original cost, accumulated depreciation data and all, directly hitting the asset account alone with revaluation surplus is wrong, sir. Because in reality, nobody will write this entry. Depreciation account debit to asset account. This entry nobody will pass in real life. Exam books and all, questions and all, they'll give you like that only, that's okay. But in real life, people only follow accumulated depreciation. Assets are maintained at original cost, accumulated depreciation account is maintained separately. So when you're revaluing an asset, it is imperative that you hit original cost account also, accumulated depreciation account also. That's why standard is giving you 2 alternatives now. First alternative is from 400, which is your existing carrying amount, to your fair value. What is the new fair value? 800. So from here to here, check the percentage change. The percentage change is 100%. That means if in the carrying amount 100% increase has to come, then there should be a 100% increase in the original cost also. There should be a 100% increase in the accumulated depreciation also. So for the changes, 1000 should become 2000, 600 should become 1200, For that, if you write the entry, automatically the net figure 400 will become 800. So if you see the entry, machinery have debited with 1000, accumulated depreciation from 600 after reach it to 1200, no, another 600 I debited. So naturally that 400 rupees will come as a balancing figure. So that we will transfer it to revaluation surplus, must be routed via other comprehensive income. That means in your P&L account, once your first section PRL is over, the second section OCA starts. In that OCA section, once you will say hi, revaluation surplus, and from there it will jump off into balance sheet. It will stand as revaluation surplus. This is one alternative. So from your existing carrying amount to your desired revaluation amount, observe the percentage change and give that percentage change to the asset account also, accumulated depreciation account also. This is one way. The other one is your present existing is 1000 minus 600, net amount 400 is appearing in the balance sheet. Make the accumulated depreciation 0. See, I want net figure 800. This you go and make it 0. Something minus nil should be 800. So this something also should become 800. Balancing. So that's all. Adjust that. From 1000, your machinery should become 800. So you will go and credit your machinery from 1000, it should become 800. So credit machinery with 200. Accumulated depreciation from 600 will become 0. So cancel entire accumulated depreciation, will become debit 600. So that leave a gap of 400. This 400 you will enjoy it as a revaluation surplus. Again you will route it via other comprehensive income in your P&L account. So this is how you adjust your asset account and accumulated depreciation account. Normal other chapters and all, casually when we talk, asset to revaluation surplus is not a wrong accounting per se, even from examination point of view also. But when you have original cost, accumulated depreciation data and all, it is definitely not right to impact asset account and directly credit to revaluation surplus. Should be little careful with that. So guys, continuing with this, then we have treatment of revaluation surplus or revaluation losses. Let's see. First time you did revaluation, and first time revaluation led to a gain. In that case, this gain must be credited to your revaluation surplus. And as discussed earlier, this is an OCA item. First time revaluation you did and you have gotten a loss. If it's a loss scenario, then it will be debited directly to your P&L account, PRL section, the top part. Then, in case we are having a subsequent revaluation, in that 4 situations we can talk. Earlier you got a gain, now also you got a gain. Since earlier you got a gain, you would be already having a revaluation surplus. Now also you are having a gain, now also you go and credit to revaluation surplus. Earlier loss, now also loss. Earlier you debited to PRL, now also you will debit to PRL only. Earlier you got a gain, now you got a loss. Since earlier you got a gain, you must be having a revaluation surplus. So this loss must be adjusted to that revaluation surplus. So debit revaluation surplus to the extent available, and any further loss debited to PRL. Means if your entire revaluation surplus is gone, still loss is a debit to PRL. Earlier loss, now you have got a gain. In that case, reverse it. Credit PRL to the extent of earlier loss, subsequent gain, or rather further gain, credited to revaluation surplus. So basically we are nullifying the old effect and giving the new effect. Ultimately, now what will you do with revaluation surplus? Assets which are upward revalued definitely will have a revaluation surplus. So what will happen to the revaluation surplus? It's a very interesting case. For example, there is a plant and machinery, 100 lakhs. So every year normally the depreciation would be 10 lakhs, 10 lakhs, 10 lakhs in P&L account. But today you have upward revalued it, fair value 120 lakhs. So 20, this became 120, and this resulted into a revaluation surplus also 20. But the life of the asset is still 10 years. So hereafter the depreciation of plant and machinery won't be 10 lakhs, it's going to be 12 lakhs. So because you have upward revalued the asset, a depreciable asset, that is also indirectly increasing the amount of depreciation in P&L account. My objective of showing or doing revaluation is what? To show assets effectively at real value. The balance sheet is more meaningful right now. But that does not mean that I wantedly am reducing the profits, because it is a notionally my depreciation is also higher in P&L account. Instead of 10 lakhs, hereafter my depreciation is going to be 12 lakhs in P&L account. So the extra 2 lakhs impact my profit is reducing. Sir, can I do anything for that? The standard says, from the revaluation surplus, to the extent of that extra depreciation, every year you can make a reserves transfer. That means you can transfer to your retained earnings an amount of extra depreciation each year. That means that 2 lakhs rupees instead of 10 lakhs, hereafter new depreciation is going to be 12 lakhs. So the 2 lakh rupees extra depreciation, that you can make a transfer from 20 revaluation surplus to retained earnings. Every year you will be writing an entry, revaluation surplus account debit to retained, not to PRL, directly retained earnings, because the profit already is reduced profit is coming to retained earnings anyway. So here you take the compensation. So this is one alternative for revaluation surplus. Another alternative is, let you provide higher depreciation. Don't compensate every year. Let revaluation surplus stay like that only in the balance sheet. Once the asset is sold off in future, one day when the asset is sold off, asset will be derecognized, revaluation surplus completely will be merged into retained earnings. So you will not do every year transfer, rather revaluation surplus will be stay put like that only in the balance sheet. At once when the asset is removed, entire revaluation surplus will jump off into retained earnings. This is another alternative what we have. So all this is given here, sir. Okay. Now coming to almost towards the end of the standard, which is depreciation part. Now depreciation is what? Whatever carrying amount of the asset is there in the balance sheet, since that carrying amount of the asset is going to give us benefits over its expected life, so a portion of that carrying amount also should come to P&L account to match the benefits it is giving. So to ensure matching concept, we have to provide depreciation on the asset. Now the standard says you should not reduce or should not depreciate the entire cost of the asset, but you should depreciate only the depreciable amount of the asset. Depreciable amount means take the cost of the asset, from that minus expected residual value. The net amount only should be depreciated. So the amount of depreciation depends on the cost of the asset, obviously, the life of the asset, which is expected life of the asset, expected residual value of the asset, and of course the method of depreciation. Now there are so many methods of depreciation like straight line method, WTV method, sum of years digits method, depletion method, annuity method, so many methods are there. The standard does not strictly ask you to follow any particular method, but it says that choose your depreciation method depending on the pattern of future economic benefits the asset is going to give you. So for example, you see there is an asset. You believe that the asset life is 5 years. For the next 5 years, the asset is going to give me uniform benefits every year. Every year, same amount of benefits is likely to be earned. Since the pattern of benefits is equal, your method of depreciation also should reflect that. So go and select a depreciation method which will give you uniform depreciation every year. So which is nothing but straight line method. Suppose you say that The asset gives me higher benefits in the initial years. As the time progresses, the benefits will come down. So in the later portion of the life of the asset, I'll get lower benefits. So higher benefits initial year, lower benefits in the later years. So you should also go for a method of depreciation where higher depreciation is charged in the initial years, lower depreciation is charged in the subsequent years. So you'll go for WDV method. So depending on your pattern of future economic benefits of the asset, you accordingly will select the method of depreciation. Some entities also choose number of units of production method. That means certain assets ka life is not based on the time period, but it's based on the number of units. For example, there is a plant and machinery whose capacity is 1 lakh units. So once you produce 1 lakh units, the asset life is over. So whether 1 lakh units you produce it in 3 years, 10 years, 15 years, doesn't matter. There the life is not defined by time, life is defined by number of units there. So in that case, you will devise a depreciation method based on the number of units produced rather than time basis. Now you see the cost of the asset is pretty much fixed, means what will go into the cost, all that we have discussed. But apart from the cost of the asset, if you see the remaining things, that is the residual value of the asset, that's an expected number. The life of the asset, estimated number. Method of depreciation, also an estimate, because SLM, WDV, all these you are estimating based on the pattern of future economic benefits of the asset, right? So out of your 4 variables, only cost is fixed. The remaining 3 numbers are basically estimates. The standard says that compulsorily you have to review this every year. So every year check whether the estimate what you made originally, is it standing still good or not. If it is not, then definitely you have to revise. When you revise your estimates, your amount of depreciation is going to change. So all these effects must be given prospectively, not retrospectively. Whenever you have changed your estimate, from that date onwards, remaining period ka depreciation should be impacted, not till today. So for example, you are in 4th year of the asset. So in the 4th year ending, if you decided that there is a change in the life of the asset, so this should impact only the 5th year and onwards. 4th year ka depreciation should not be disturbed. Even though 4th year books of accounts are still open and all, you are still standing in the 4th year also, don't disturb 4th year ka depreciation, because prospective effect means only for future period you have to change. So when will you charge providing depreciation? When you put the asset to use, or when the asset is ready for usage? The answer is asset is ready for usage. Answer is ready for usage. Now sometimes there is a very interesting situation like this. Suppose you are in year 7. The asset has a life of 10 years. Okay. When you are in 6th year, you felt that the asset ka residual value is 10,000 rupees. And keeping that residual value of 10,000 rupees in mind, you provided depreciation. All is well. Today, 7th year ending, depreciation still did not provide. Carrying amount of the asset is 35,000. For some reason, in the market, residual value of the asset has increased. Residual value of the asset after 3 years when I sell it, I will get 40,000. Last year also my carrying amount was 35,000 after providing depreciation. In the 7th year, I have to provide depreciation, but before I provide depreciation, I have to once check whether the residual value and all are holding good or not. When I checked that, I observed that the expected residual value huge increase is there, and the asset will definitely have a value of 40,000 or more by the end of its useful life for me. But in my books, the asset is already appearing at 35,000. When the asset worth itself is 40,000 after 3 years, today my asset is already appearing at 35,000 in my books. I have already over depreciated the asset. In year 7, no depreciation. So what about year 8? When you go to year 8, we'll again have to review. Go and check the residual value. If here the residual value is 30,000, your asset book value is 35,000, so still there is a 5,000 rupees gap. So 8, 9, 10 years, so over a period of 3 years of 5,000 rupees you have to depreciate. So like that. Sir, what if even at the end of 4th year it is still standing at 40,000? No depreciation in 8th year as well. So you cannot reduce the carrying amount of the asset below its estimated residual value. If it has already come down, we cannot do anything but reverse the depreciations and all, but no depreciation in a particular year is possible. It's a very interesting case. Once the asset is held for sale in accordance with Ind AS 105, non-current assets held for sale, then from there onwards, Ind AS 105 will apply, Ind AS 16 will not apply. In that case, you will not provide any depreciation. So this is all the points that are about depreciation, sir. Now coming to the last aspect, almost the important one. This is changes in estimates for decommissioning and restoration cost. Very interesting one, but very easy one also. So there is an asset whose life, let us say, is 10 years. On first day, this asset has a decommissioning liability, decommissioning obligation. So when you estimated the decommissioning cost, you estimated that as 1 lakh rupees. Since you estimated that as 1 lakh rupees, its present value is 30,000 rupees. Example. So what I would have done on the very first day, we would have capitalized it to PP and also would have created a provision for decommissioning with an amount of 30,000. Now, 5 years is over. So when I prepare my balance sheet at the end of year 5, my PP is appearing at some amount because every year I provide depreciation and all. So after providing depreciation, some amount is appearing. Provision for decommissioning liability, even though originally recognized at 30,000, every year I am doing unwinding of discount. That means I book interest cost and I correspondingly increase the value of the liability. So the 30,000 over a period, over a period of 5 years, let us say it has become 62,000. So if I leave it like this for the next 5 years, every year if I book interest, 62,000 will become 1 lakh eventually. So numbers are not accurate, just rough numbers I am telling. Now when I am standing at the end of year 5, I feel that this amount won't be 1 lakh. The amount is gonna be 1,50,000. Revised estimate of decommissioning costs. So instead of 1 lakh, and I am now re-estimating it as 1,50,000. Now, how will you account for this increased liability? So first and foremost thing you must understand, this liability, whatever is appearing in your balance sheet, that is eventually by the time the asset life comes to an end, it should represent the expected decommissioning cost, right? So 62,000 rupees, even though you do unwinding of discount, it will ultimately become only 1 lakh, but will not become 1,50,000 now. So what I should do, I should change this number in such a way that this revised number, future value will become 1,50,000 now. So that's pretty easy. So what you do, discount this 1,50,000 to today. So let us say this is some 90,000 rupees. So I should have an amount of 90,000 rupees and not 62,000 rupees. That means you are asking me to basically increase it by an amount of 28,000. Happily we will do. So half of the accounting is there itself done now, sir. So decommissioning liability should be credited with 28,000. The question is, where will I debit this now? So the debit impact, where will it go? So it's an obvious question, no? Because see, initially when you recognized the liability, corresponding hit you gave it to asset. So now also you are increasing the liability, corresponding asset has to go to asset only. So very obvious thought. The answer is true, but you should be careful. Where it should be careful is, the answer is adjusted to the cost of the asset, correct, only when the asset is followed at cost model. The asset is maintained at cost model. What is cost model? You are simply providing depreciation, nothing else. In that case, the answer is definitely correct. You will go and debit your PP. If cost model is followed. Sir, what if I follow revaluation model? In that case, why can't I go and hit the cost of the asset or carrying amount of the asset? Why you cannot hit is, when you are following revaluation model, what does it imply? Prima facie, you are following revaluation model to ensure that the asset is displayed in the balance sheet at a value which is equal to its fair value. You go and disturb that number with any number, then it won't be fair value anymore. No, for example, if you are not following cost model, but if you are following fair value model, then this number is basically fair value. If I go and add anything to that, how can it become fair value anymore? Are you understanding this? So, when the asset is maintained at fair value or revaluation model, you will not touch PP account. So, in that case, what will I do? It's a very simple point, sir. Though in the standard they did not write like this, but for our understanding, I am telling you. So, if cost model is followed, this is what you will do. If the asset is maintained under revaluation model, in that case also there is no escape from this. No. This you have to definitely increase it by 28,000. Now debit where? Now you think like this. Is increasing decommissioning liability good or bad, or it's a gain or loss? It's definitely a loss, because you have to incur more amount of money to decommission the asset or restore the environment back to its original condition. Since it's a loss, you treat this as a revaluation loss. Now you will think over. Revaluation loss means, what is the treatment of revaluation loss? What is the treatment you have for revaluation loss? Depends. If it is a first time revaluation loss, PRL. Earlier also revaluation loss, now also loss. Again, this entire 28,000 will debit to PRL. Sir, no sir, earlier I have a revaluation surplus, then you will adjust against that revaluation surplus. Sir, but existing revaluation surplus is only 15,000, sir. So out of 28,000 loss, 15,000 you will adjust to revaluation surplus, remainder 13,000 throw it up into PRL. So it is like that. So revaluation loss treatment, since you already know, just execute that. Sir, what if you have taken an example where decommissioning liability has increased? What if decommissioning liability is decreasing? In that case, similar things, sir, similar things. Provision for decommissioning to PP when cost model is followed. If revaluation model is followed, then provision for decommissioning with the amount of change in the liability as on today's state. This time I cannot touch the asset value, then you will treat this as a revaluation gain. So the treatment of revaluation gain, again the same thing, whatever we discussed here. So those points are given here. So what will you do when will you de-recognize the PP? When you sell it or you discard the PP, or you believe that the PP is no more capable of giving any future economic benefits, then definitely you have to remove the PP. Any gain on de-recognition of PP must be transferred to your PRL. So subsequently, some of the standard covers with impairment, deals with impairment of these assets and all. Such impairment loss treatment is again given in that standard. But for example, your asset gets damaged or something like that. For that, any insurance company is giving you some claim, or third party is giving you some reimbursement of damages and all such gains also will go directly into your PRL whenever you have a right to receive such gain. Compensation for impairment loss. So guys, that's all with your PP standard, sir. So we'll come up with the next asset standard quickly. So let's come into the definition of intangible asset. Intangible asset is defined as an identifiable non-monetary asset without any physical substance. In this, the without any physical substance part is the inherent nature of intangible asset. But apart from that, the remaining terms are also equally important. For example, the standard says if you have to qualify as an intangible asset, first of all, you must be identifiable. So now what is the meaning of the term identifiable is? It's simple, sir. It's just like you have to establish the existence of this asset in its own worth. That means the own worth of this asset our own identity of this asset must be established. Now, how will you establish this? The standard says there are two ways in which you can do that. Number one, if you can prove that this asset is separable, then it is identifiable. Now, what is the meaning of separable? Suppose, sir, in your balance sheet, you are having plant and machinery, you are having debtors, you are having software, you purchased a patent or you have developed a patent for yourself for some product in your company. Then you have some inventory, you have some building. So many assets are there in the balance sheet. Now you ask yourself one question: is it possible for the entity to sell off this patent to somebody else and still continue the business with remaining assets? Is it possible? Answer is yes, it is quite possible. Can we exchange the software of our entity with some other asset, or you can sell the software to somebody and still continue business with remaining assets? Quite possible. That means if an asset alone can go away and still you can and asset alone can go away for a consideration, and with the remaining assets, if you are capable of continuing your business, what it means is this asset what you are giving away is not representing your entire business. That's a part of your business. That's a small asset which has its own worth. Since it is capable of sold individually, we are saying that it is having its own worth. Therefore, it is separable and hence it is identifiable. Now look at this example. We all understand goodwill is an example for intangible asset. But you observe now, can you sell goodwill to somebody and continue your business normally? Tell me, sir, how can I sell only goodwill in the market? I cannot sell only goodwill. No, if I have to sell goodwill or if I want some consideration to be received towards the goodwill of the entity, there is only one way. I have to sell the entire business to him. If I sell the entire business, then only I will be able to get something towards the goodwill of the business, isn't it? That means you cannot sell only goodwill. You have to sell it along with a group of assets and liabilities. So goodwill is not an identifiable asset. It does not have any value on its own. But software, patent, copyright, trademark, these kind of things, they have their value that alone can be distributed, sold, rented, exchanged with some other benefit, even without disturbing the entire business. So, if you have to qualify as an intangible asset under Ind AS 38, you must be identifiable. You must be identifiable. So, goodwill is not an identifiable asset in terms of Ind AS 38. Sir, if it is separable, then it is identifiable. Sir, is there any other way? Yes. If you are having any legal or contractual rights which are evidencing the existence of an asset. For example, government has given you a license to do some mining activity. For the next 5 years, you have a license to mine this entire coal blocks in a particular area. This license what you have, you cannot sell it, you cannot rent it, you cannot exchange it with any other party. Only you must use this license. Thus, that means is it separable? The answer is no, it is not separable because you are not permitted to sell it to somebody. But I still have the right to extract coal out of this mine or limestone out of this mine for the next 5 years. Yes, I do have. So some legal proof must be there. So government has given me a license. That itself is a legal right. Similarly, I acquired a business. When I acquired the business, the old owners, I pay consideration and I ask them to get out. But these old owners, since they know how to do the business very well, even if they get out with the help of all their contacts and all in this business, they can start another entity and eventually hurt me only. So what I do while going, I'll pay some extra money to them and make them sign some non-compete agreement. Next 10 years, you are not supposed to do this business in this particular country or in this particular states like that. So that's a non-compete phase. These legal rights or contractual rights or some government rights are there. So that's a kind of evidence that this is existing. So how you will prove your identifiability is either it must be separable from your business or there should be some legal or contractual rights which are evidencing the existence of the asset. This is about identifiability. Next one, coming to asset. The term asset, the general definition, asset is a economic resource controlled by entity as a result of past event from which future economic benefits are anticipated. So important word is control. So a resource from which future economic benefits are anticipated, that's okay, but that benefits must accrue only to our entity only. That is called as the aspect of control. So all the decision making rights we should have, and we should have the power to enjoy the economic benefits from the asset. Usually that kind of benefits will come when you are having legal rights. So since I am able to prove that I am the owner of the asset, so I am ideally entitled to enjoy the benefits from the utilization of the asset. So control is important. So control must be there. When control is not there, forget about intangible asset. You are not even having a asset in the first place, because asset definition itself is a resource controlled by the entity. So what is control is a ability to obtain all the future economic benefits from the asset, and also to prevent others from enjoying the benefits of the asset, because the asset belongs to us. Now coming to the term non-monetary. Now what is the meaning of non-monetary? So basically it's a negative definition. Monetary means receivables are monetary items, something which can be convertible into money. For example, you see, I am having a patent, okay, which is in the form of a legal right, paper is there. I am also having a bills receivable. Bills receivable is also a paper. Both are legal rights only. Bills receivable gives me a right to use a particular, bills receivable gives me a right to collect a particular amount from a particular person on a so and so date. Patent gives me a right to use a particular formula or whatever it is protecting. So both are giving rights only. But only non-monetary assets are intangible assets. For example, if you observe, technically there is no difference between a bills receivable paper or a license paper. Both are papers only, both are legal rights only. But intangible assets do not cover monetary items. Receivables are scoped out of the standard. So some other standard, financial asset standard is there. So this bills receivable and all, debtors and all, which are monetary items, they are not covered under the standard. So intangible assets cover only non-monetary items. So non-monetary assets without physical substance, if they are identifiable, then they become a intangible asset. And the inherent characteristic, which is no physical substance. So obviously intangible assets should not and do not have a physical substance, but the intangible element is often stored in a physical device only. For example, software is stored in a CD. The licenses and all are written on legal documentation. Legal papers are, they are not tissue papers. No, so they do have some value. Of course, for that matter, tissue paper also has some value. So you pay 1,000 crores to get a license, but the license is written in a huge bunch of documents. The value of the documents, the document basically is a physical hard copy on which the intangible element is coded in that, is given to you in that. Sir, but that, so when you pay 1,000 crores, you are paying some amount even towards that hard copy also, no? Yes. But you are not supposed to separate it. That's part of the intangible asset only. So the storage device cost, usually you should not split it. Next. This is one favorite area of ICA. There are many questions in study material also. That is, these are the list of items which sound like intangible asset, or in many questions the companies go and capitalize them as intangible assets, but they are not supposed to be capitalized. They are to be thrown off as expenditure in your P&L account. In that are heavy advertisement expenses, training costs, preliminary expenses, relocation costs, startup expenses, and initial inauguration expenses and all. You cannot capitalize any of them. All of these expenses are to be thrown off into PRL account. Next, the recognition criteria of intangible asset. When will you recognize intangible asset? That means intangible asset account, when will you open in your books of accounts? Again, the same recognition criteria whatever you studied in PPA standard. That means when it is probable that future economic benefits from the intangible asset will flow to the entity, plus the second criteria is also extremely important. Cost can be measured reliably. Coming to measurement of intangible asset. Again, same thing. It depends on how you are acquiring the asset. If you are acquiring a ready-made intangible asset, then obviously in the intangible asset must be recognized at its cost. Now cost includes what? Purchase price. Any volume discount, trade discount you receive, you remove that. Any legal expenses you incur, you can capitalize that. Non-refundable taxes you pay, you can capitalize that. Any valuation expenses you incur, you capitalize that. Installation expenses, you can capitalize that. So intangible asset, what installation expenses? Suppose you buy a ERP modules. So every software won't be like, no, double click it, next, and restart. No, so some installations are quite complicated. So installation itself is a huge process sometimes. So for some intangible assets, installation expenses must be capitalized. Any other directly attributable costs. Similarly, this point is again there. What is that? Deferred settlement terms. Deferred settlement terms means you obtained the asset on abnormally large credit period. In that case, the seller of the asset or the vendor of the asset definitely will charge interest from you. So the ultimate payment what you are going to make to that fellow after 3 years includes interest. So that interest cannot be part of the cost of the intangible asset right now. So what should you do? Depending on the data, sir. If the question gives you cash price, then capitalize the asset at its cash price right now. In case the question does not give you cash price, but the question gives you some discounting rate. So in future, whatever amount you are going to pay, that amount discount it to today and recognize the intangible asset at that price. In any eventuality, the interest portion should not be capitalized into the cost of intangible asset right now. Next one. Intangible asset acquired by way of exchange of asset. This principle is literally similar to whatever we discussed in India 16. That is what, go and check. You acquired an intangible asset, you gave away some other asset. Is there commercial substance, yes or no? If there is a commercial substance, the answer is yes. If there is a commercial substance, then the incoming intangible asset should be recognized at fair value. Sir, fair value of which asset? Preferably fair value of assets given up. If that is not available, then take the fair value of intangible asset acquired. The outgoing asset must be removed at its carrying amount. So entry a gap will come, that will go to PRL. If you say that, sir, there is no commercial substance, or if you say that commercial substance exists, but fair value cannot be worked out, in that case, the incoming asset should be recognized at carrying amount of asset given up in such a way that gain or loss should be zero. So this is about that. Next one. In PP standard, we discussed self-constructed PP. Like how we discussed self-constructed PP, here also self-constructed intangible assets are there. That only we will discuss in a while with the name of research and development phase. So at that time we will cover that. This part I had to include it in the middle because there are too many questions in ICS study mat based on this. But as such, this is directly covered under Ind AS 103. So anyway, quickly we'll recognize, we'll discuss this also. So for example, you are A Limited, you are acquiring another company B Limited. In the process of this, whatever net assets you are acquiring, all these net assets must be recognized at fair value. Some exceptions and all are there, but broadly the principle is all the net assets acquired in the business combination must be accounted at their fair value. PC you will pay something. So if PC ki net assets ki gap will come. This gap only will become your goodwill. If you pay more, it is goodwill. If you pay less, it is a bargain purchase gain, which ultimately will be reflected in your capital reserve in the balance sheet. Right. Now the question is, this B Limited has an intangible asset. They have an intangible asset. That intangible asset you A Limited also took over. But this intangible asset, they have it, but they don't reflect that in their books of accounts. Sir, why sir? Maybe it's a license which they bought. They thought that it is not capable of giving any more benefits. They have written it off. But the license is still valid and A Limited took over that license. Can A Limited capitalize such license which is not appearing in the books of B Limited? Yes, provided it satisfies your definition and recognition criteria, definitely A Limited can capitalize such intangible assets also. At what value? At fair value. Next. This B Limited, the selling company or the acquired entity, incurred some research expenses and there is a work in progress going on. When A Limited absorbs B Limited, all the work of B Limited also will be taken over by A Limited. That means this research work also will be taken over by A Limited. Hereafter, who will do the research? A Limited will do the research. So based on your basic understanding of intangible assets accounting, you all know that research expenses cannot be capitalized. Any research expenditure incurred should be thrown off to P&L account as an expenditure. When B Limited incurred that, they put it in P&L. Hereafter, when A Limited incurs that also they will put it in P&L. But this research WAP, whatever A Limited is taking over from B Limited, that any amount, whatever is paid towards that should be recognized as a separate intangible asset at fair value. Sir, why this exception? This again we will discuss in Ind AS 103, but per se it's simple, sir. Whether you recognize this as a separate asset or not, PC la you are paying some amount towards this research WAP. If you do not recognize this as a separate asset, the amount whatever you are paying towards this will go and sit in the balance sheet with the name of goodwill. Because my PC amount is fixed. My net assets are 1, 2, 3, 4, 5 items are there. I want to write 6th item research WAP 1 asset. If you let me write that asset, I will capitalize it as an intangible asset and I'll write it off in the remaining period, whatever 3 years, 5 years, some policy I will make, and I'll write off that research expenditure into P&L account. But if you don't let me capitalize this research work in progress as a separate asset, and you say that 1, 2, 3, 4, 5 assets only you should capitalize, fine, my PC is not going to change, but you are making me not recognize one asset called as research WIP. Because of that, what happens? That gap will go and sit with the name of goodwill. And once it becomes goodwill, there is no amortization for goodwill. So there is every possibility that it will sit forever in the balance sheet. So we know that research expenditure should not be capitalized, but if I do not recognize research WIP as a separate asset, there is every possibility that it will sit in the balance sheet forever. So standard makes an exception there. But hereafter, the remaining research expenditure, whatever A Limited incurs, that definitely has to go into their PRL. There is no doubt in that. Next, there are some self-generated assets like self-generated goodwill, self-generated brand, the lot of customer data what you might have developed over the course of your activities, the formulas what you use in your business, publishing titles. All these are highly valuable items. Goodwill value can be worked out. Brand will have a huge value. Customer data is very, very important. People pay crores to get customer data. So all these are valuable. All this your entity also may have, but they cannot be shown as intangibles. Why? Recognition criteria, second point is missing. What is the recognition criteria? Second point, cost cannot be measured reliably. When cost cannot be measured, you know the value of your brand, but you do not know the cost incurred to get that brand. You know the value of your goodwill, but what is the cost you have incurred to achieve that goodwill? That cannot be reliably measured. Since cost is not known, you cannot capitalize them as asset. Next, coming to the important aspect, which is research and development cost. Now, what is the difference between research phase and development phase? Research phase is the process of investigation, where we are trying to identify something or we are trying to get or obtain knowledge. This investigation process is called as research. Once a research is successful, you will establish that okay, an idea is going to work. Now, transforming this idea into an intangible asset, this process is called as development. So, investigation process is research. Once research is successful, we mean that okay, one idea is successful. This idea now you have to translate into an intangible asset. The second phase is called as development phase. Now, if you observe, during research phase, you will go on incurring expenditure just to chase one bug in your mind, whether this idea will work or will not work. So, as you are incurring expenditure, is it probable that the research will be successful? There is no probability, right? Because the research can fail also. Ultimately, my idea may be failure also. So, throughout the research phase, whatever expenditure you are incurring cannot be capitalized as an intangible asset. Entire amount will be thrown off to P&L account as an expenditure. Even if research becomes successful in future, the amount which is transferred to P&L account cannot be capitalized and all, because even if your research is successful also, you will not have an intangible asset in your hand. You will only get a comfort that your idea works. So research expenditure, there is no discussion. Entire research expenditure must be transferred to P&L account as an expense. This is about research phase. Now coming to development phase. Development phase starts when research is successful and you prove that, or you are quite confident that your successful idea can be translated into an intangible asset. The standard says that in development phase, whatever expenditure you are incurring, because ultimately it can be translated into an intangible asset, this development expenditure can be capitalized provided the following 6 conditions are demonstrated continuously. So throughout the phase of development, all the 6 conditions whatever are mentioned in the standard, all the 6 conditions must be completely satisfied continuously. Any time you fail any one of these 6 conditions, whatever development expenditure you capitalized till date also should be written off to P&L account immediately. Now, what are these conditions? Number 1, technical feasibility of creating the intangible asset. So, your idea is successful, all that is fine, but is it feasible to create an intangible asset with this idea? So technical feasibility, that means availability of materials, getting appropriate approvals, all this must be possible. So first of all, you have to establish technical feasibility. The standard also very clearly says that any cost incurred before establishing technical feasibility shall be recognized as expense. So this technical feasibility itself is one step. So once you decide that okay, intangible asset creation is possible, up to that stage, even the expenditure incurred for checking the technical feasibility also should be thrown off into P&L account. After technical feasibility is established, whatever amounts are there, that can be capitalized provided all the 6 conditions are satisfied. One is technical feasibility. Second one, ability of the entity to use or sell the intangible asset. See, we are with lot of difficulty, we are creating an intangible asset. Ultimately, this intangible asset should be capable of giving benefit to us. Now, how will I get benefit from an asset? Either I should use it or I should be able to sell it. So, entity should have that ability. So, second point is we are testing on ability. First one is feasibility. Second one is ability. Third point is about intention. Does our management have intention to complete the development process and eventually see light till intangible asset is created? So whether the management prima facie has the intention to pursue the development process or not, also you have to check. Next, availability of technical and financial resources. Management has intention, the ability to use and all is there, but money only is not there. So even though development process started in the current year, there is no guarantee that we will be able to spend money for the next 4 or 5 years throughout the phase of development. In that case, what is the fun of capitalizing expenditure today? So write it off to P&L account. No sir, we are having lot of money, we are backed by so many investors and all. So whatever it takes, we are going to pursue the development. Then fine, you can capitalize it. So apart from these 4 conditions, the original 2 conditions, what are the original 2 conditions? It is probable that future economic benefits will flow from the intangible asset to the entity, plus the cost can be measured reliably. These 2 points, whatever recognition criteria we studied for intangible asset, those 2 are anyway there. So apart from the 2 basic recognition criteria, extra 4 points you have to satisfy. Number 1, feasibility, that is technical feasibility, ability, intention, and availability of resources, FAIR, FAIR. So you can remember this as feasibility, ability, intention, and resources availability, plus the basic 2 points. So as I already discussed, research expenditure once gone to P&L account will never come back to balance sheet again, even though research is successful. Next, similarly, imagine sir, I started development, year 1, all 6 conditions satisfied, capitalized. Year 2, all 6 conditions satisfied, further more amount capitalized. Year 3, out of the 6 conditions, 1 condition failed. So year 3, whatever expenditure I have incurred, everything will go to P&L account. Not only that, year 1, year 2, whatever I have already capitalized, that also will be thrown off into P&L account. Year 4, no work. Year 5, no work. Year 6, again I incur development expenditure. Again, all 6 conditions satisfied. So, year 6, year 5, whatever expenditure I have incurred, that again I can capitalize because all the 6 conditions are satisfied, because now we are resuming the development. But whatever is already thrown off into P&L account, that cannot be recapitalized. That is not possible. Once an amount has been written off to P&L account, either during research phase or during development phase because of failure of any of the 6 conditions, that amount subsequently cannot be capitalized. Next, the standard says that, chalo, with lot of difficulty you passed all the 6 conditions, you ultimately made it to the balance sheet, some amounts you have capitalized towards the development asset in the balance sheet. But what is the guarantee that all the amount whatever you have incurred during development process, that can be recovered in the form of future economic benefits? Because you might have capitalized so much expenditure which may be irrelevant also. So as auditor and all, how will I check all that? The standard gives one ultimate knockout punch. What it says is, go and do a compulsory impairment testing every year. In impairment testing, what will we do? We will compare the carrying amount of the asset with its recoverable amount. If carrying amount is more than recoverable amount, that means carrying amount is 1000, but recoverable amount, the benefits what I am going to get in future is only 800. So when the benefit is only 800, how can you state 1000? A extra 200 should be recognized as impairment loss and thrown up into P&L account. So even if you satisfy with lot of difficulty all the 6 conditions, the standard won't leave you there. It is asking you to do a compulsory impairment check at the end of each year. So once you do that impairment check, I will be satisfied. Okay, whatever amount is appearing in the balance sheet, that is definitely recoverable in the form of future economic benefits. So that is the standard ultimate intention. subject to compulsory impairment testing each year. As you all know, impairment is not a regular exercise. No, impairment you will do only when there are indications for impairment. But this is an exception. There are three exceptions. One is goodwill. The other one is intangible asset under development, the point what we are discussing right now. And the other one is we are going to discuss in next 2-3 minutes. That is intangible asset with indefinite life. Suppose you purchased a stock exchange membership right. So as long as the exchange is there, the life, you are a member in that. So what is the life of that? I don't know. Nobody can measure that. It's just like the life of a company. So how can I amortize it? So I cannot amortize. No, since you cannot amortize it, the standard says go for a compulsory impairment. So there are three scenarios of compulsory impairment testing. So one is goodwill in a business combination. Number two, intangible assets under development, and intangible assets with indefinite life. These three cases you have to do compulsory impairment testing, even though there are no indicators. Next is capitalize all directly attributable expenditure, cost of materials, services consumed, cost of employee benefits, fees to register legal rights, amortization of other assets used in the development of current assets and all. And obviously it's a basic point. Now, do you not obviously capitalize general admin cost, staff training cost, abnormal assets and all? No fool will capitalize. Subsequent expenditure. Already intangible asset is there, you are already amortizing that. Any further expenditure on that, can I capitalize it? Again, same principle like PP. If it is contributing to additional incremental future economic benefits, you will capitalize it. Otherwise, you will expense it to P&L account. Now, subsequent measurement. So, in the balance sheet, at what value will it appear? Again, the story is same as what we discussed for PP. You have two choices of either cost model or revaluation model. Any model you can follow. All the principles are ditto same as in day 16. We spent time there, so again we need not discuss all this. Coming to almost the last aspect, very important aspect, which is amortization of intangible assets. So whatever is depreciation for a tangible item, for intangible items we call it as amortization. Again, how much amount you should amortize it? There, same principle, depreciable amount, not the cost of the PPE. Similarly, here also not the cost of intangible asset. You have to amortize the depreciable amount. Depreciable amount means cost of the intangible asset minus expected residual value. So, cost of the asset minus residual value, the net amount only should be amortized. So, let's see. First aspects are special points regarding useful life of the asset. Now, if you remember, by chance, in AS 26, it makes a rebuttable presumption that the life of an intangible asset cannot exceed 10 years. There is no such thing like that in AS 38. Whatever life it is there, it can be there. For example, the government gives you a license to operate telecom services in India for a period of 25 years. But you believe that new technology will come in the next 15-20 years. So even though you have a right to operate a 2G license for 25 years, but subsequently 3G, 4G and all will come. And the maximum benefit will come because of this license only for a period of 15 years. So your useful life is going to be only 15 years, even though the legal life can be different, the contract life can be different, but useful life is different. Useful life is the period over which asset can be beneficially put to use. So useful life is that. Contractual life can be higher, legal life can be higher, that is different, but obviously useful life cannot be higher than legal life. No, when government itself has given you a license to use it for a period of 25 years, you cannot say that my useful life is 45 years, that is wrong. So you should be careful there. Sometimes when you get an intangible asset, you have for a particular period, you will also have a right to renew the intangible asset. For example, you initially got it for a period of 10 years, but you have a right to extend it by another 5 years. Now, can I consider that extra 5 years period or not? The answer is yes. If it is if it is indicative that you are going to extend and renew the rights, then definitely you can take the life as 15 years. That means even the renewal period also can be included. Then, as discussed earlier, intangible asset can have finite or indefinite life. Finite means life is fixed. Since useful life is fixed, happily you will amortize the intangible asset over its estimated useful life. But if it's having indefinite useful life, like a stock exchange membership right, since the life is unlimited, you cannot amortize it. Since you cannot amortize it, such kind of assets must be subject for compulsory impairment test every year. So that is about useful life points. Now coming to residual value. Now if you observe, in the case of PP, since PP is a tangible item of asset, at the end of its useful life, even though the asset is not in working condition, since it's a tangible item, at least it will fetch you some scrap value. But intangible assets, if you observe, most of the times intangible assets do not have any residual value. The reason is, imagine sir, government gave you a license which you can use it for a period of 25 years. If you say that my useful life is also 25 years, then at the end of 25th year, the license expires, no? So you cannot even sell it to anybody. So the residual value at the end of 25th year is 0. But is it possible that legal life is 25 years, but I believe that it is useful to me only for a period of 15 years. So I will amortize it only for a period of 15 years, but the asset still has another extra legal life of 10 years. So what I may think is, at the end of 15th year, I may sell it off to some other party. Possible. The standard says you can take residual value for intangible asset only when there is a third party commitment for that. That means somebody has agreed to buy this intangible asset from you at the end of its estimated useful life, or there is an active market, established market, where this kind of intangible assets are traded and their values can be reliably measured. So only in those cases, either there should be an active market for trading this kind of assets, or there should be a third party commitment. Only in these cases you can include residual value. In any other case, the residual value will be taken as 0. Coming to amortization method. Now you see, just like in the case of PPE, the method of amortization basically depends on the pattern of consumption of economic benefits, right? If benefits are uniformly accrued from the asset, then SLM is correct method. Or if they are falling down over a period of time, so something like WDV, sum of years digits method, these methods are good. If the life itself is mentioned in terms of production units, so the benefit of the asset is expressed not in terms of years, but in terms of its capacity to yield a particular number of units and all, then production of units method is appropriate. So depending on the pattern of future economic benefits from the asset, you select an appropriate method for amortization. But the standard is very clear that revenue based amortization is not permitted. You cannot take intangible asset and amortize it to P&L account in the ratio of sales. Year 1, year 2, year 3, year 4, year 5, next 5 years sale is estimated. A sales ratio low, I have amortized my intangible asset to P&L account. This is not permitted unless the benefit of intangible asset itself is linked to revenue. For example, you did lot of expenditure in the last 5-10 years, and you identified that there is a particular gold mine, huge gold mine is there in a particular area. You reported it to the government. What government told you is, do one thing, since you are the person who earthed this gold, you identified this gold, we should also appropriately reward you. So what you do is, you dig the gold and sell it till you make a revenue of 2000 crores. So once you make a revenue of 2000 crores, you should get away from here. Remaining gold belongs to the government. So government gave me a right. Now there, my benefit is linked to what? I extract the gold and I sell it. Till I receive sale proceeds of 2000 crores, I have right on this gold mine, isn't it? Now if you observe, this intangible asset, I will amortize it in how many years? Now I have to estimate. Year 1, 2, 3, 4. It will take 5 years for me to extract gold and sell it till I reach a revenue limit of 2000 crores. So first year I am making some 400 crores. Second year I am making some 600 crores. Third year I am making some 300 crores. Like that, I make an estimate of my revenue in the next 5 years or 6 years. So whatever cost I have incurred for this intangible asset, that I will amortize it to P&L account in the ratio of this sales. This is the only case where revenue based amortization is permitted, because the benefit of intangible asset is directly expressed in terms of revenue. Here revenue is a limiting factor. Once I reach a particular limit of revenue, my benefit from the intangible asset gets exhausted. So only in that case revenue based amortization is allowed. In any other case it's not allowed. In the recent RTP November 24, there is a question on intangible asset amortization where the question has given you next 4-5 years ka revenue. You are not supposed to touch that. Revenue based amortization is not permitted. Finally, derecognition of intangible asset. When will you remove intangible asset? If it is sold, obviously you have to remove it, or you did not sell it but you believe that the asset is no more capable of giving any future economic benefits, then also you should eliminate the intangible asset from your books of accounts. So any gain or loss will travel to PRL. So guys, that's all about your India's 38. Standard, sir. Investment property is basically the standard covers real estate assets. Real estate assets are what? Land and building. Why do people invest in real estate, land and building? Either for capital appreciation or for rental income or for both. So let's see the formal definition. Investment property is a property. It's a land, building or both held by owner or lessee as a ROU asset. That means you need not be a legal owner. Asset should be appearing in your balance sheet. See, if an asset has to appear in your balance sheet, if you are an owner, the building or land and building will appear in your balance sheet as an asset, obviously. Even if you are a lessee, as per India's 116, you write the entry ROU asset account debit to lease liability. No, so you will have an asset in that case also. So in case you have a asset in the form of land, building in your balance sheet, either as an owner or in the capacity of a lessee, with an objective to earn lease rents, rental income, that is, or capital appreciation or both, then whatever asset you are having, that asset is called as an investment property. So prima facie, you should be having a land or building in your balance sheet. Now think, how will I have a land or building? If you are an owner, obviously you will have a land or building in your balance sheet. If you are a lessee, then you will have a ROU asset which is also representing land and building. And this land and building must be given on rent, or it must be held for capital appreciation, or both. Then this land and building or ROU asset, whatever you are having, that we will call it as investment property. Now, any other land and building other than this, that means suppose I have office building, I have factory building, all these are used for production of goods, rendering of services, administrative purposes and all. They are called as owner occupied properties. They are not in the scope of India's 40. Now, it is like this, sir. So there is land and building. India 16, PP we have seen. PP definition says that it should be a tangible item of asset held for use in production of goods, rendering of services, admin purposes, and giving on rentals to others. Now, we are not talking about plant and machinery, vehicles, office equipment and all. We are only talking about land and building. So, time being, we will not talk about all the PPs. We will be bothering ourselves only about land and building. So, when a land and building is held for usage for production of goods, rendering of services, administrative activities, this land and building is covered in the scope of Ind AS 16, which is PP standard. But when you have a land and building or land or building which is used for giving on rentals, then this comes into the scope of Ind AS 40, because earning rental income is the objective of investment property. So it comes into the scope of Ind AS 40. Any other land and building, they are under this standard are referred as owner occupied properties. Sir, they are PPs. No, sir. Array, sir, PP is the name of the standard India 16. But land and buildings alone, which are used for production of goods, rendering of services, or for administrative purposes, they exclude only land and building. I am talking, they are referred as OOP, owner occupied properties. Similarly, there is an entity whose day-to-day business is buying and selling properties. So their ordinary course of business itself is that. So in that case, they may be having land and building in their balance sheet, but they will get classified as inventories, because buying and selling houses, lands and all is their day-to-day activity. So when you see land and building now, you can understand there are three scopes possible. Number one, it can be covered under Ind AS 16 if they are using it for their own purposes. If they are buying it and selling it in the ordinary course of business, Ind AS 2 inventory standard will be applicable. If they are holding it for the purpose of rental income, capital appreciation or both, then only Ind AS 40 is applicable. Right, sir. So this is about the definition of investment property. Now some examples also are there. All are important. Standard is a very simple standard. Land held for long-term capital appreciation. The following are examples of IP. Okay, land held for long-term capital appreciation. This is obvious only. There's nothing very great in this. Now come to this one. This is important. Land held for a currently undetermined future use. So you have a land, but you do not know what you will do with that in future. Whether you use it for the purpose of your business or capital appreciation or rent, or you'll plot it and sell it in the ordinary course of business. Today, no clarity is there. The standard says doesn't matter. Still, it is an investment property. A building is owned by the entity and leased out under one or more operating leases. Leased out is rented out. So I am the owner of the building, and under operating lease, if I have leased, the building is still appearing in my balance sheet. No, because if I have leased it under finance lease, then I will have to derecognize this asset from my balance sheet. So since you have leased out under operating leases, it is like a building is there in your balance sheet and you have given it on rent basis. Definitely investment property. A building that is vacant but it is held to be leased out under one or more operating leases. So today it's vacant only, but my intention is to give it on rent. So it's an investment property. A building that is being constructed or developed for future use as an investment property. Building is not yet ready. It's under a process of construction, but eventually I will be giving it on rent. So definitely IP. The following are the cases of not investment property. Let's see who are there here. Property intended for sale in the ordinary course of business. So you have a property which you are going to sell it, or you are constructing a property which eventually you will sell it in the ordinary course of business. Definitely India's 2 inventory standard will be applicable for it. Owner occupied properties like where India is 16 or India is 116, like you are using it for future use. Held for future development and subsequent use as owner occupied property. Owner occupied property means what? Production of goods, rendering of services, administrative purposes, all that. You have some buildings which you will give it on rent only to your employees. What rent you are charging, concessional renta, higher renta, market renta, that is irrelevant. If you have a property which is kept exclusively for giving on rent only to your employees, it's as good as you are using it for the purpose of your business only. Owner occupied property, it is not a IP under Ind AS 40. Property leased to any other entity under a finance lease. It's a joke this is. When a property is leased to another entity under a finance lease, a property itself will not appear in my balance sheet. I have to derecognize it, obviously. So anyway, property held for more than one purpose. So for example, you have something like this. Oh, this is not actually a building. Chalo. You have 2 floors building. One floor you are doing your own business. The top floor you have given it on rent. Both the floors belong to you only, you are the owner. But one portion is used for earning rental income. Another portion you are conducting your own business. Now, how will I handle this case? The standard says, is it possible to sell, rent, exchange each part separately without disturbing the other one? Of course, it is possible. I can sell the first floor and retain the ground floor. No, possible. I am not asking you to do that, but it is possible. No, that means the fair value for each part can be identified separately. Yes. So what the standard says is, take the cost of the building, split it into 2 parts in the ratio of fair value. That first floor, one portion will be IP, another portion will be covered under PP because you are using it for the purpose of your business. So in the ratio of fair value, you have to split it. Suppose you have a single floor property like this, where you have given single room only is there, entire thing you have given it on rent. One small portion alone you kept for yourself, where you are running a small pawn shop. This is your main business. One small partition you kept under that room only, to facing outwards, where you are running a pawn shop. This is your main business. But remaining 95% of the area you have given it on rent. Now I cannot sell only this small area covering some 50 feet or 60 feet. That small area I cannot sell because nobody will buy that. They have to sell. I have to sell the entire thing. It means splitting of this property for sale is not possible. In that case, what our standard says is, this asset entirely should be treated as investment property, IP only, provided the quantum of the property used for other activities should be insignificant. That means The property that is used for other than investment property, that nature, that activity should be insignificant. If that is insignificant, then entire thing you will call it as investment property. If it is insignificant. So for example, in the entire property, if this is representing some 5% area, 5% can be considered insignificant. See, the standard does not give any percentages and all, just like example I am explaining. So 5% is definitely insignificant. So even though 5% is used for other than investment property, it's used for some other activities for conducting my business and all, that's okay. The entire asset can be treated as investment property, not a problem. But suppose it is not 5%, if it is 25%. If the area which is used for my business activities is 25%, that is not majority, that is not substantial, I agree, but that is definitely not insignificant, no. 25% is quite an area, that need not be majority, that need not be substantial, but that is definitely not insignificant. 25% is quite material enough. In that case, I cannot classify this as IP. I have to treat the entire property as property, plant and equipment. India 16 will be applicable. The language of the standard is like that. You should be little careful with this. So dual purpose, unable to split. If you are able to split, then life is simple. No sir, take the fair value and split it off. Unable to split, then India is 40. That means investment property classification only if insignificant portion is owner occupied. Insignificant means very, very minor. Little above minor also you use. It need not be major again. If it is significant, that's enough. You cannot call it as IP. You have to go to India 16 PPE standard. You have to apply. Next. Suppose, sir, there is an apartment. Inside some 40 flats are there. Imagine you are the owner of all these 40 flats put together. So you have 40 flats, every month they will nicely give you rental income, life is happy. Now, apart from giving the property on rent, as an owner, you took the responsibility of providing security, maintenance, garden activities and all, water, these kind of services also you are providing. Each flat they are giving you 30,000 rent, plus you are also collecting 5,000 rupees extra for maintenance and all. So total 35,000 rupees rent overall you are receiving every month. Now, whatever rent you are receiving, is it only towards property or some amount towards some services provided also? That means you are receiving not only rental income, you are also providing some service, and towards the service also you are getting some income, isn't it? So is it not like I am using my property to deliver a service and make money? Yes, in a way yes, indirectly yes. But what our standard feels is, look at the quantum. Majorly your rent is because of the flat, what you are giving it on rent, because of the property. Of course, some minor activities, security, cleaning, all this you might be providing, they are ancillary activities. So this is ancillary and not significant. This is major. Therefore, even though there is a small service component, that is okay. We will ignore that. We will treat this entire thing as a investment property. On the other side, imagine you again are a owner of a building. Now you are using this as a lodging and boarding hotel. Where per day you charge 8,000 rupees rent per day. Now in this case also, whatever you are receiving from the customer is rent only. In the above case, whatever you are receiving from your tenants also, that is also called as rent only. But there you are receiving 30,000 per month, here you are receiving 8,000 per day. Why? It's still the same. In fact, there you are giving one entire flat, 2 BHK you have given, here one room you are giving 8,000 rupees you are charging. Why are people willing to pay so high? Not because you have provided 4 walls and a roof, no. It is for the services. You provide a fully furnished room. You provide so many services on a phone call. Food is available inside. So here the major component is not the property alone. Major component is services. Since services component is major, this particular kind of business is not an investment property. This is an owner occupied property. Ind AS 16 will be applicable. So what you have to catch is, when along with the property services are also offered, you have to check whether those services are either major or minor. If they are ancillary and minor, then no problem, it's an investment property. But where services take the major component, then definitely it is not an investment property. Okay, this fifth point also in small case is there. Let's discuss that. Suppose, sir, X Limited is a parent entity. In its balance sheet, they are having a building. This building, they have given it on rented to subsidiary Y Limited in a operating lease. Since it is an operating lease, the building will continue to appear in the books of lesser parent company. So building is already appearing in the balance sheet of X Limited, and since they are earning rental income, pakka investment property. Now this Y Limited, this fellow is a lessee. Since he is a lessee, he would have recognized ROU asset account debit to lease liability entry. The same building only in the books of Y Limited, it is reflected like this. Y Limited is a subsidiary company. Now Y Limited, using building for production of goods, they are using it as a factory building. They are manufacturing goods there. Now, in the SFS of X Limited, in the standalone financial statements or separate financial statements of X Limited, this will be reported as an investment property, because only X Limited point of view, X Limited objective is to earn rental income. But when X Limited prepares consolidated financial statements, X Limited has to report this building as a PP, because consolidated financial statements is prepared from group point of view. Group means parent and its subsidiary. Now parent plus subsidiary put together, ultimately how this building is being used. This building is used for manufacturing of goods, which is an owner occupied property. Ind AS 16 must be applicable. So SFS law Ind AS 40 is applied, CFS law Ind AS 16 is applied. It's a very good case. So based on all the examples what we have given, one tabular chart is given, you can go through that. Next, recognition criteria. We need not even read this. Recognition criteria is same, sir. Probable that future economic benefits will accrue to the entity plus cost can be measured reliably. Initial measurement, all these are same to same points, sir. Initial recognition should be done at cost, and cost means purchase price, add non-refundable taxes, any expenditure for registering the asset on your name and all, any brokerages, consultation fees paid, that all can capitalize. If you have constructed it on your own, then startup cost, operating losses, abnormal losses and all cannot be capitalized towards it. Deferred settlement terms. Deferred settlement terms already discussed. Abnormally large credit period when you take, then either cash price or present value of the future cash outflow what you are going to incur. When IP is acquired by exchange of another asset, you have acquired an investment property by giving away some other asset. In that case, again the story is literally similar to whatever we discussed under Ind AS 16, which is you have to check whether commercial substance exists or not. If commercial substance exists, incoming asset should be recognized at fair value, preferably fair value of assets given up. If that is not there, fair value of asset acquired also is okay. If no commercial substance is there, incoming asset should be recognized at carrying amount of outgoing asset in such a way that gain or loss is zero. Day-to-day replacement cost, maintenance cost, day-to-day servicing cost, maintenance cost, all this will be transferred to P&L account. Replacement cost, for example, one wall is broken, one huge wall, so you constructed a new wall, so the cost of new wall obviously will be capitalized, but the carrying amount of the existing wall which is now demolished, that existing wall carrying amount somehow you have to work out and you have to de-recognize to that extent. Just component accounting part. Subsequent measurement. Here something is important now. See, in PPE and intangible assets, subsequent measurement points are same. That is, the standard gives you two choices, either cost model or revaluation model. But Ind AS 40 is slightly different here. Ind AS 40 gives you only one choice, which is cost model. You do not have the choice of following revaluation model for investment properties. Only cost model is permitted, revaluation model is not permitted. That means all you have to do is just to provide a depreciation, and any impairment indicator is there, do impairment loss also. That's all. Sir, but I want to show all my assets at fair value. No sir, this is my objective. All my PP intangible assets I am measuring at fair value. True, but unfortunately presently Ind AS 40 does not permit that. But what it mandates is fair value has to be disclosed. Compulsorily you have to disclose. You cannot fair value for accounting purposes, but fair value the asset for disclosure purposes. Fair valuation is mandatory, but you cannot account fair value. Sir, why like this? Now you see, sir, Ind AS 40 is taken from IAS 40. IAS 40 interestingly does not actually have revaluation model. They have a cost model or a fair value model. Fair value model is different from revaluation model in the sense, revaluation model, as we have discussed earlier, you have to provide depreciation, then after depreciation carrying amount and the real fair value, the gap is quite significant, then you will actually go and do revaluation. Otherwise you don't do revaluation usually. But fair value model is not like that. Fair value model of IAS 40 is something like your FVTPL. So match your existing book value carrying amount directly with the fair value. Any gain or loss, book it in PRL, no depreciation, nothing. That is fair value model, something like FVTPL. So that is there in IAS 40. While making Ind AS 40, they removed that. So presently in Ind AS 40 today we have only cost model. We don't have fair value model. So what is there in IAS 40, International Standard 40 is not revaluation model. That's fair value model directly, like FVTPL of Ind AS 109. But anyway, today fair value you have to work out only for the purpose of disclosure. Next, transfers or reclassification. See, whether you will call something as some land and building as investment property, or whether you will call it as a PP, or whether you will classify it as inventory, prima facie depends on your intention, isn't it? Intention means the manner in which you will use the asset. If your goal is to buy and sell in the ordinary course of business, inventory, use it for the purpose of your own business, goods, services, admin activity, then it is PP. No sir, capital appreciation, rental income, then it is IP. So it is quite possible that there is a change in the usage of the asset. That means all these days my use is something. So accordingly classification is made. But today my use pattern, the change is there. So hereafter the classification also will change. So therefore it is possible that till yesterday what is PP, from today onwards I may have to reclassify it as IP. Or it is possible that what I have called it as IP from so many years, hereafter I have to classify it as PP or inventory possible. The standard allows that, provided there should be change in usage supported by some evidence. So for example, I have rented out this property. I have an investment property. I have a building which I have rented it out to so many tenants. I am calling it as investment property. Today, I want to use it for the purpose of my business. So today, my intentional change is there. Now, what is there, sir? Till yesterday you applied Ind AS 40. From today onwards, I will apply Ind AS 16. What is there? Not so fast. What the standard says is, show me some proof that there is a change in your usage terms, usage pattern, the change is there. Show me some proof. How will I show proof? If I am going to use this building for the purpose of my business, then I have to evacuate the existing tenants. So I have to give them notices to kindly leave the premises within the next 2 months, 3 months. That giving that notices to the tenant is a proof that there is a change in the usage pattern of the asset. So I can reclassify from my IP to PP. Similarly, all these years I was calling it as PP because I am using it for my office purposes. From today I want to rent it out and therefore classify it as investment property. So for that, what proof can I show you? I am vacating this office building because we have taken a new office building. So we are all migrating there. And I have advertised everywhere that I am looking for tenants and all. So that is good enough proof that there is a change in my usage pattern. Similarly, I have a land. I am calling this as IP from so many years. But now I thought that since my main business itself is not doing well, Why don't I convert this land into small pieces and I sell it off in the ordinary course of business? Now I am entering into real estate venture. So he plotting this land into small pieces and all the work started. I applied to the government and all this is a proof that my change in the usage pattern has changed. In these cases, reclassification is permitted. And know what? Reclassification will happen only at the carrying amount of the property. Whatever amount it was appearing as IP, that amount only is a starting point for PP. Whatever amount is appearing towards PP, from today onwards, IP also same amount it should be transferred. Whatever amount is appearing as it is. That means because of reclassification, gain or loss should not be possible. There should be no gain, no loss purely because of reclassification. As it is carrying amount, you have to make the transfer. Next, as discussed earlier, fair value of investment property every year you have to do only for the purpose of disclosure, sir, not for accounting. Accounting at fair value is not permitted for investment properties, only for disclosure purposes. Now that too, entities are required to measure the fair value of investment property for the purpose of disclosure. An entity is encouraged, this is important guys, an entity is encouraged but not required to measure the fair value of investment property based on valuation by an independent valuer. So to the extent possible, get it valued from a professional independent valuer. Then the standard tells you that what if your fair value of investment property is not reliably measurable. Sometimes the investment property may be under construction. Until the construction is completed and all, we will not be able to measure it. In that case, the standard says, chalo, no problem, you record at cost, whatever cost you are incurring, that only you will record anyway. But fair value and all you need not disclose, but disclose the fact in the notes to accounts that the property is under construction. So today fair value is not available. So till fair value is available, you go on giving this disclosure. Once the property is completed, most likely fair value will be available, you will start disclosing that. So that is one scenario. Another scenario where this is not an investment property under construction, but still fair value is not available, cannot be reliably measured. In that case, you have to give a continuous disclosure like this. A description of IP. I have a property, land, building in so and so area. Explanation why fair value cannot be measured reliably. So this is an area which has been recently coming into government's purview and all, or existing buildings are demolished by some authority by the government. So last 2-3 years of not even a single transaction also happened. Therefore, fair value cannot be worked out. If possible, the range of estimates within which the fair value is likely to lie. So exact fair value you may not know, but at least a range, a minimum and max value, that much at least you can have to provide. While measuring the fair value of the investment property, an entity should ensure that the fair value reflects rental income from the current leases and other assumptions that market participants would do. All this is okay, disclosure points. Ultimately, when you sell off the asset or you feel that the asset is no more capable of giving any future economic benefits, then you have to derecognize the asset. Any gain or loss on investment property derecognition should be going off to your PRL. Same in the case of PP, same in the case of intangible asset standard also. Now coming to disclosure aspect, this is important guys. You have to disclose the accounting policy. Accounting policy standard gives you only one accounting policy, follow cost model, simple. Any amounts recognized in the PRL for rental income. How much rental income did you recognize? And towards that property, what are the direct operating expenses you incurred? Maintenance fees and all, whatever you have incurred, all that, repairs, maintenance, all that explanation you have to disclose. It should be there in your P&L account. P&L account anyway you will show. Notes to account, separate disclosure is what they are asking. Sir, there is a question in your study mat which is important guys, where the question gives you so much data. That data is for giving the disclosure. In that question answer also they expect you to write all these disclosures. The depreciation on investment property. Carrying amount of IP at the beginning and carrying amount at the end reconciliation. That means additions, disposals, depreciation, that gap. Fair value of investment property obviously is very important. And to the extent to which fair value of IP is based on valuation by an independent valuer who holds a recognized and relevant professional qualification. So did you get the valuation done by an independent professional valuer or not? That's important. If there has been no such valuation, the fact shall be disclosed. So guys, that's all. This is about your investment property. We'll take up next standard, which is mostly agriculture standard, sir. See, despite the simple standard it is quite capable of coming for 8 to 10 to 12 marks as well. So anyway, let's go into it. So India's 41 agriculture standard is applicable for these three items. So the scope is very simple. We cover the accounting of biological assets, we cover the accounting of agricultural produce, we cover the accounting of government grants related to biological assets. So only three items are covered under this standard. Okay, now biological assets, initial recognition, subsequent measurement, everything is covered under this standard. Agricultural produce is covered under this standard only at the point of harvest. That means from a mango tree, you pick up all the mangoes. So once you pluck the mango, that becomes an agricultural produce, no? So on the very first day, what accounting is to be done is standard tells you. Subsequently, what you will do that mango with that mango, whether you will sell it or you will use it as a raw material for further preparations and all, that is not into the subject matter of Ind AS 41. Ind AS 41 applies to agricultural produce only on the point of harvest. Harvest means the moment agricultural produce is created, at that time, the moment you pluck the mango, on that date, what entry, what amount you should record, Ind AS 41 talks about that. Subsequent processing of that does not apply. Ind AS 2 will take care of it, inventories. And government grants which are related to biological assets are also covered under this standard only, even though you have Ind AS 20 separate standard for government grants. Reason we will discuss as we go inside that. Now coming to scope exclusions. Land which is used for agricultural activity is important activity, important asset, but still that land is not covered under the scope of Ind AS 41. Similarly, bearer plants are not covered under the standard. Bearer plants are also biological assets. Any living animal, living plant is a biological asset. So mango tree, coconut tree, all these are also bearer plants. They are also biological assets, but they are not covered under the standard because they are covered under Ind AS 16. Ind AS 16, self-constructed PP is there. So whatever is the actual cost incurred for construction of asset, those principles only must be applied even for biological assets which are bearer plants covered under Ind AS 16. Grants related to bearer plants are also not covered here. Intangible assets used for agriculture, intangible asset standard is applicable. RO assets arising on lease of land. If you have taken land lease and the land is used for agricultural purposes, the RO asset measurement is not covered under the standard. Ind AS 116 will apply for that. Anyway, coming to the most important part. So the standard nothing is there, very simple standard. Only thing is you should be very good with the definition part. You understand definitions clearly with lot of clarity, then automatically standard is as good as over. So let's start like this in a particular order. Let's start with biological asset. A biological asset is a living animal or plant. That means the term living must be given for animal, also plant also. Now, what is an agricultural produce? Okay, before we go into that, let's come here. Harvest. The term harvest refers to detachment of produce from the biological asset. So, from the tree, if you pick up the fruit, you detached the produce from the biological asset. From the sheep, you have taken out the wool. So, you are taking out a produce, you are detaching a produce from a biological asset. That process is called as harvest, or the cessation of biological assets life process. For example, you have a lot of hen. You have killed some hen, converted that into chicken. So as long as it is a living animal, it is hen. It's a biological asset. The moment you killed it, converted into chicken or mutton, then it is becoming an agricultural produce. This process of ceasing the life of biological asset is called as harvest. So harvest can mean two things. There is a biological asset, living plant or animal. From that produce alone you have detached it. So taking fruit from a tree, wool from a sheep, eggs out of hen, these are all coming into this category. And the term harvest also includes ceasing the life of the biological asset. That means sheep, goat and all converted into mutton, chicken means hens and all converted into chicken. That means where you are killing the animal and converting that into meat. This process is also harvest. Now come back. Agricultural produce is harvested product from entity's biological asset. So once you detach or once you kill the biological asset, the end result of product is there. No, that harvested product is called as agricultural produce. Ind AS 41 is applicable to all the agricultural produce only at the point of harvest. Subsequent processing of such agricultural produce is outside the scope of the standard. On the balance sheet date, agricultural produce will be valued as inventory in accordance with Ind AS 2. The subsequent measurement and all Ind AS 2 will be applicable, but on the first day, mangoes, wool, eggs, or the meat, at what amount you should recognize, the milk from the cows, at what amount you should recognize, the standard will give you guidance. So till now, what definitions did we cover? Biological asset we have covered, agricultural produce we have covered, harvest and a word also we have covered. Next, biological transformation. Any living being goes through 4 phases. These 4 processes put together are called as biological transformation. The processes are growth. So in a tree or animal, it grows, and beyond a particular stage, it starts degenerating. That means animal ka size becomes slow. As you see, the calf eventually over a period it grows into cow. But as the cow gets aged and aged, again the animal starts shrinking. The same happens with the trees also. Trees towards the end of their life, they get dried up and all the leaves and fruits will be gone. The color of the tree, barks and all will change. That is degeneration phase. Production. Animals give milk, fruits and flowers are given by trees. So this is production during its life. Procreation. Procreation is giving life to new biological asset. Cow giving birth to calf is procreation. So these 4 processes put together is called as biological transformation. It happens with all the living beings. Now coming to the definition of agricultural activity. Agricultural activity means it is management of what the entity should manage. It should manage the biological transformation and harvest of biological assets. So there are 2 things. Biological transformation, that is the process of growth, regeneration, production, procreation. Harvest means detaching the produce from the biological asset. These 2 activities our entity should be managing. With what objective? With the objective of selling them. That means a biological assets they can sell, or converting into agricultural produce. So your goal is not to sell the biological asset, but your goal is to sell the agricultural produce. That means you are having a poultry farm, let's say. So you maintain so much of hens and all. Ultimately your goal is to sell their eggs or sell them as meat. So agricultural produce, or conversion into additional biological assets. That means you are having this fishery activity where your goal is to create so many fishes and ultimately you sell the fishes. So your goal can be to sell the biological asset or to sell the agricultural produce or to create more and more biological assets with the intention of again selling them. So with these objectives, if any entity is managing the biological transformation and harvest of the biological assets, then that entity is said to be involved in agricultural activity. So that is it. Now the following, so there are so many questions, I've just summarized this point. The following activities are not treated as agricultural activity. Ocean fishing. Daily, or some people will go on a boat into the ocean, they throw a net, catch some fishes and come back and sell that fishes. This is not agricultural activity because these people are not managing the biological transformation of the fishes and all. They are simply going and catching fishes and coming back. Deforestation, that means you are cutting down plants and you are selling them. Animals used as carrier vehicles. Suppose there is some temple or a shrine on a hill. You are having some 10 horses on which you make pilgrims sit and slowly safely carry them upwards. Here you are definitely making money by using animals, but how can carrying people on horseback become an agricultural activity? Where is biological transformation for the purpose of selling additional biological assets or for agricultural produce? Animals used for security purposes. You are having some 20 dogs which are used as security purpose. True, since you are maintaining dogs, obviously you will be involved in the biological management of biological transformation of dogs and all. But that does not mean that you are doing agricultural activity. No, because your goal is different. Your goal is not to sell the agricultural produce of those animals or create additional biological assets and all. Your goal is to use them as security purpose. That's why. Similarly, animals displayed in zoos, in zoo, circus and all, you use animals as a display items, or will train those animals, make them do some funny feats and sell tickets. So you, even though you are maintaining animals and you are involved in the biological transformation management of those animals, that does not mean that display of animal in zoo or using animals for the purpose of circus and all, that does not become agricultural activity, obviously. So then the standard defines what is bearer plant. This is the same definition what we have covered already under Ind AS 16. We are not going into that. Now, for example, mango tree is there, a coconut tree is there, grape vines are there. All these are bearer plants because they are capable of giving agricultural produce more than 12 months. They are primarily held for agricultural produce only, remote likelihood of being sold. Correct? No? So they are definitely bearer plants. So this mango tree, coconut tree, grape vines, all these apple orchards, all these are not covered in the scope of Ind AS 41. They are covered under Ind AS 16 PP. However, in the grape vineyard, the grapes that are there on the tree, in the apple orchard, the apples that are there on the tree, the mangoes that are there on the tree, the coconuts that are there on the tree, they are all part of biological asset only. But once you extract them, once you harvest them, that becomes a agricultural produce. Once it is an agricultural produce, even though it is from a bearer plant, that agricultural produce is under the scope of Ind AS 41. Right? So agricultural produce is covered from all biological assets. All biological assets are also covered under the standard except for bearer plant. Next. Now, what is the recognition criteria? Recognition criteria is the same recognition criteria what we discuss for any other asset. What is that? It is probable that future economic benefit should be that will flow into the entity. Number two, cost can be measured reliably. But here, apart from cost, another word, fair value or cost of the asset can be measured reliably. So everywhere, Ind AS 38, which is intangible asset standard, 40 investment properties, Ind AS 16, everywhere cost only is given. Why here fair value is given? That is because as you understand the recognition principles, initial recognition of PP, intangible asset, investment property is happening at cost. But as we learn now, initial recognition of biological assets will not happen at cost. It should be happening at fair value less cost to sell. So that's why fair value of the asset must be measured reliably. One more point is there, the entity should have control on the asset. Of course, even though the asset definition itself includes control over the resource on a term, the standard specifically includes here in case of biological assets that or agricultural produce. For these two cases, the standard includes this as an additional condition. So apart from your future economic benefits, cost or fair value should be measured reliably. Second condition, there is a third condition now, the entity should have control over the asset as well. So this is a third condition which the standard is expecting you to fulfill. Once these 3 points are satisfied, you can recognize biological asset or agricultural produce as an asset in your books of accounts. Now coming to the measurement criteria. Let us do this with the help of an example. Biological asset. Listen, sir. Initial recognition of biological asset or agricultural produce should be done only at fair value less cost to sell. Here also same principle. Fair value less cost to sell. So if you sell this asset, biological asset or agricultural produce outrightly, immediately in the market, whatever amount you get, that is the fair value, minus expenses of sell, cost to sell. If you remove, one net amount will be there. That is the amount at which you recognize biological asset or agricultural produce in your books of accounts. Okay, sir. Now, agricultural produce, after initial recognition, subsequent measurement and all, is standard is not applicable. Ind AS 2 will be applicable. Now let's focus on biological asset with the help of an example. So let us say on 1/4/2023, A Limited purchased 5-year-old cow for rupees 40,000 and paid 1,000 rupees expenses. To sell the cow, we have to pay expense of 1,500. So the buyer of the cow is paying 1,000 rupees. The seller of the cow has paid 1,500 rupees to the broker. Now, cost of transporting cow from market to A Limited's premises, let us say, is 500 rupees. Now, what entry will you write for purchase of this biological asset cow? Now, carefully understand, sir. It's very simple. You will identify two numbers separately. First, you work out FELCTS separately. Fair value. Since you purchase the cow today for 40,000 at the market price, today if you sell the cow at the spot in the market, that is fair value, no? Sell the amount what you get for selling your asset. So that, imagine that only is a fair value, 40,000 minus cost to sell. In this sum, I am a buyer. But in case if I sell the asset right now in the market, I have to pay expenditure of 1,500 rupees. The question can give this in the form of percentage also. So let us say 1,500 rupees expense on sale. But if I have to sell this cow in the market from my place, I have to take this cow to the market. No, transportation charges will be there. See, the cow today is there in the market only. Imagine I got it to my home. From here, if I have to sell it, I cannot sell it from here. I have to take this cow to the market. So this transport charges, whatever are there, the transport charges must be definitely factored for determining fair value. So as a part of determining fair value, you have to remove transport charges. Careful, sir, transport charges is not part of cost to sell. It is part of fair value only. Of course, even if it is cost to sell also I will deduct, but you must understand the difference. So the net effect answer is 38,000. So the cow should be recognized at 38,000. That is clear, because FELCTS you have to apply. Cash outflow, what you paid. I paid 40,000. I paid 1,000 rupees brokerage as a buyer. I paid 500 rupees for transporting the cow from the market to my place. So what I paid is 41,500 rupees. Now remember this, sir. Your entry will be this. Biological asset account debit cow to bank. To bank is my cash outflow 41,500, but I will recognize this only at 38,000. This gap, whatever is there, let it be expenses, let it be loss on valuation, let it be transport charges, there is no need for you to recognize each one of them individually and show. Simply throw it off into PRL. We will simply explain it as a loss on initial recognition. That's it, sir. That's exactly what you are going to do. So, no confusion, man. FELCTS separately work out. How much you paid separately work out. Asset must be recognized at FELCTS. The gap, put it in P&L account. Khatam, game over. So, this is the entry you are passing on 1/4/23. Okay. Now, let us say you are standing on 31st March 2024. Now, information available is FELCTS of 5-year-old cow today is 41,000. FELCTS of 6-year-old cow is 44,000. See, our cow existing carrying amount is appearing at 38,000 in our books. Initial recognition principle is FELCTS. Subsequent measurement also should be done at FELCTS only. So Ind AS 41 says there is no depreciation and all. Subsequent measurement also at FELCTS. So from your 38,000, you have to measure to what value? See, when I purchased the cow was having an age of 5 years. Now that 1 year is over, now cow age is 6 years. So you have to compare with 44,000. So from 38,000 to 44,000, there is a 6,000 rupees gain. So biological asset cow account debit to this is again directly happily go off into PR. Valuation and directly to PR. So guys, that is that. Now there is a small disclosure requirement here. That means your fair valuation gain is 6,000 rupees. This 6,000 rupees has to be further broken down into how much is due to price change, how much is due to physical change. This breakup you have to show in the notes to accounts. How much of this gain is attributable to price fluctuation? So how will I know? See, when you purchased the biological asset cow, your FELCTS for a 5-year-old cow is how much? 38,000. Today, same FELCTS for a similar 5-year-old cow. Your cow is actually now 6 years, but a similar 5-year-old cow, if you buy today, it would be at 41,000. FELCTS would have been 41,000. So from 38 to 41, whatever gap is there, this 3,000 rupees, this is purely because of price change in even the same similar 5-year-old cow, you can buy or sell at effective cost of 41,000. So from 38 to 41, whatever is there, that is price change. Remainder, whatever is there, another 3,000 rupees, that's because of the age factor, the physical change. Of course, it can be either increasing or decreasing, but in this case, both are increase only. So this part you have to give it as disclosure. Now, if you tell me that, sir, cow gave milk, what is the entry you will record? If cow gives milk, milk is an agricultural produce. So agricultural produce account debit. So whatever is of FELCTS of the milk, let's say it's some 6,000 rupees, to directly recognize in PR. Suppose if it is not milk, suppose you have killed the animal and you converted that into meat. Even that meat is also agricultural produce. No, in that case, agricultural produce meat, of course, this will be recognized at FELCTS of the meat. 2, since you have killed the biological asset, you have to derecognize it. This derecognition will happen at its carrying amount. Any gap definitely will be there. That gap will be transferred to your PRL again. So agricultural produce entry depends on whether it is detached or biological asset ka life process is ceased. Accordingly, the entry will change. Next, one small exception is there. Suppose, sir, small exception. Suppose you incurred some expenses and you are doing some plantation activity, which is getting covered into the definition of agriculture. But this plantation is based on your research, what you did. There is no similar kind of plantation that is available in the market as on today. So this is first of its own kind. So you know how much expenses you incurred because you already spent. So you know how much expenses you incurred, but you do not know what is the FELCTS of this. Is it possible like that? Yes, because see, there are some kind of plants and all whose seeds ka DNA and all is cultivated in the lab. So I took some natural ingredients and then I mixed it up. I created a synthetic plant and I am trying to create some product out of that for medicinal purposes. So this kind of activity when I am doing, I'm trying, this is a part of agriculture only. Definitely there's a living plant only, and I am managing the biological transformation of that plant. Definitely this is pakka agricultural activity. Now, I know what I incurred, but I do not know fair value because there has been no such kind of activity anywhere near me. So fair value cannot be worked out. In that case, what will I do? What our standard says is, in rare cases where fair value cannot be determined, in that case, biological assets should be recognized at cost. And whatever is the life of that biological asset, you estimate and provide a depreciation. So you have to, this is an exceptional rare case where biological assets are recognized at cost and depreciation is provided, where when FELCTS could not be ascertained. So all this is discussed, sir. The entries, model entries and all I have given. You can go through it. Then in the notes to accounts you have to explain the remeasurement changes because of price change and physical change separately. Finally, government grant for biological asset. Now look at this very simple case, sir. Now, Ind AS 20 deals with government grants. What it tells is, you have an asset. Related to this asset, if you receive a government grant, you have two alternatives. Alternative 1, reduce from asset. Alternative 2, treat it as deferred income. So Ind AS 20 or AS 12 in your C-Enter, everywhere the two alternatives that are there, they are there. When anyway Ind AS 20 is there, why is this standard again talking about government grants related to biological assets separately? Let's think over like this. Imagine this standard is not there. Imagine this standard does not cover about these grants. So which standard is applicable? Ind AS 20 is applicable. So you have a biological asset now, and related to this biological asset, you received a government grant. Then you have right to apply any of these two alternatives. If you apply the first alternative, the entire principle of Ind AS 41 gets violated, because this biological asset initial recognition, subsequent measurement, everything is to be happening only at FELCTS. So you are showing this asset in the balance sheet at FELCTS, and you received a government grant related to that, and you go and reduce it from the cost of the asset or carrying amount of the asset. Then the resulting number is no more FELCTS. No, entire Ind AS 41 ideology, you are spoiling it off. So the standard says, if it is a government grant related to biological assets which are initially recognized at FELCTS, then Ind AS 20 will not apply. Ind AS 41 only has to be applied. Let's see what is there in Ind AS 41. Basic points are, you will see whether the grant that is given to you is conditional or not. If it is an unconditional grant, then why to set it up as deferred income and all? Straight away it becomes an income in your P&L account. When the grant is receivable, immediately book it as income in your P&L account. Khatam, game over. But if you say that the grant is conditional, that means some conditions have to be satisfied in order to earn the grant, even though you might have received the grant. In that case, you have only one alternative. You have to set it up as deferred income initially and recognize the government grant in P&L account when the conditions attached to it are met. Till then, treat as deferred income. You will only treat it as deferred income immediately and release it to P&L account as and when the conditions are satisfied. If there are no conditions at all, unconditional grant, right away go into P&L account as income. All this is there in Ind AS 20 also, but in Ind AS 20 there is another alternative of reducing it from the value of the asset, which is not permitted now because your asset is prima facie measured at FELCTS. When your asset is measured at cost, then Ind AS 41 says I am not applicable. Go to Ind AS 20. Because anyway your asset is not appeared at FELCTS. No, any of the alternatives you follow, I don't care. So go to Ind AS 20. So guys, that's all with your agriculture standard, sir. On this, some good questions are there in your ICS study material. Please go through that. This is a good enough discussion on agriculture standard. Thank you guys. Thank you so much. Assets. See guys, the goal of this standard is to ensure that the carrying amount of the asset in the balance sheet does not exceed its real worth, which is in the standard called as recoverable amount. So there are two numbers which you have to compare. One is the carrying amount, which is the amount that is appearing against the asset in the balance sheet, versus another number called as a recoverable amount. Now what is that recoverable amount, in which scenes you have to compute that and all, that we will see in the standard. Anyway, now at a very simple outset, I will just tell you the overview of the standard, and then let's go into the nitty-gritties of each and every item there. Now you see, sir, for example, I have a plant and machinery. Against this plant and machinery in the balance sheet, I am having an amount of 5 lakh rupees. So this 5 lakh rupees, I am calling it as carrying amount. This should be the number after providing the depreciation. If you are following revaluation model, then do the fair valuation. After every adjustment, the ultimate amount that is appearing against plant and machinery is 5 lakh rupees. Okay. Now, in some scenarios, you have to determine the recoverable amount for this asset. Now, how to determine recoverable amount? At a simple outset, it is like this. Recoverable amount is higher of, number one, fair value less cost of disposal, or just for easy understanding, I am writing it as fair value less cost to sell. Of course, disposal need not be sell. Disposal is much broader word. Sell is one way of disposing the asset. But just for convenience, I am writing. If you right away sell this asset in the market, how much will you get? Net of expenses. So net selling price, sir, today's, that is called as FELCTS. So let us say the FELCTS came to 3,80,000. That means this asset is capable of giving you a benefit of 3,80,000 if you outrightly sell the asset without having any intention to use it further. The second one is called as value in use. Now value in use, roughly listen how to compute. Some more points we'll discuss as we go further deep into the standard. Let us say the asset is capable of functioning for another 5 years. For the next 5 years, estimate what cash flows the asset is capable of generating. So, whatever cash flows the asset is capable of generating, the cash inflows for the remaining life, work out that. To generate this cash inflows, if you have to incur any expenses, some outflows are required in order to generate this inflow. The direct outflows related to generating inflows, remove them. At the end of the estimated life of the asset, if the asset is capable of giving you any salvage value and all, consider that. This net cash inflows, what you are having, this number, all these net cash inflows, you will discount it to today. This present value number basically is nothing but if I don't sell the asset but rather continue using the asset for the remaining life, in terms of cash inflows, what the asset is likely to give me, in terms of that cash inflows, what is the worth of that asset as on today. So that present value is called as value in use. Now, let us say this number came to 4,20,000. There are two ways in which you can enjoy the benefit from the asset. One is sell it or use it. If I consider the sell route, then I am going to get 3,80,000. If I am considering the use route of the asset, then I am going to get 4,20,000. Standard says, let's assume that the asset is put to best possible usage only. That's the reason take the higher. So the higher one is 4,20,000. That means the recoverable amount in our example came to 4,20,000 rupees. That means the asset can maximum provide you a benefit of 4,20,000 rupees standing today, nothing more than that. Now let's see in the balance sheet at what amount are we showing the asset at. Now this plant and machinery is having a carrying amount of 5 lakh rupees. That means the carrying amount is definitely higher than the recoverable amount. When your worth is only 4,20,000, you cannot state 5 lakh rupees in the balance sheet. That excess amount, whatever is there, that we call it as impairment loss. So therefore, impairment loss is equal to 5 lakhs minus 4,20,000. This 80,000 rupees is a impairment loss that you have to book and reduce the value of the asset. Now, after impairment loss, the revised carrying amount of the asset will be 4,20,000, which is nothing but the recoverable amount. Hereafter, depreciation should be provided by taking 4,20,000 rupees as the base. Hereafter, in the sense, not for the current period, the period after which the impairment loss is provided. For example, impairment loss is provided at the end of 4th year. Then, for the remaining 5 years, when you provide depreciation, you have to consider 4,20,000 as your base. It is like that. Sir, broadly, this is the story, sir. Now, normally in real life also, when we see so many entities, audits and all, we don't regularly come across this adjustment of impairment. We see depreciation, we do see fair valuation when assets are being measured at revaluation model and all. But impairment, not very not very common seen in real life. The reason is, like how you provide depreciation, like how you fair value your assets under revaluation model, this is not a regular event. You will do this entire drama of impairment only when indicators for impairment exist. If indicators for impairment do not exist, then you need not do any impairment check. Now, once again, this entire process of you determining FELCTS, you determining value in use, selecting the higher one, comparing that with your carrying amount, seeing if there is any loss or not, all this drama, this process is called as impairment testing. And impairment testing is something you will do only when indications are there. When there are no indications, you will not be doing any impairment testing. Now what are the indicators for impairment? It's an important aspect from conceptual point of view, but examination point of view, it's not that relevant. Anyway, now the standard has given you certain illustrative indicators. So these are not exhaustive indicators, these are illustrative indicators. So if any of these things you see, it's an indicator that your asset might have lost its value. So you have to go and do impairment testing on your asset. Now there are two categories in this. One is external indicators, the other one is internal indicators. External indicators means, examples are, there is a substantial decline in the market price of the asset. You purchased an asset, but subsequently the price of the asset has fallen down. There is a significant increase in the market interest rates. Sir, if market interest rates improve, why it is an indicator that asset has lost its value? Now you see, sir, if you go back to your financial management concepts or your AFM concepts, whenever you evaluate the decision of buying an asset, you use the NPV technique, and net present value is present value of cash inflows minus present value of cash outflows, that discounted by required rate of return from the asset. How much return do you want from this asset? Now, how much return do I want from the asset? That is based on the interest rate in the market plus certain extra risk premium in this asset. That means these cash flows, what I'm going to get from the asset are not risk-free cash flows, and they are risky cash flows. So for taking that risk, I want certain extra return also. So the risk-free rate plus some extra return, both put together is my required return from any asset or project. So that required return will be used as discounting rate. Now, when I accepted this project, market risk-free rate was 8%, example. So NPV according 8% plus some extra return I wanted, let's say that is another 8%, 8 plus 8, 16% is my discounting rate. Now after 1 or 2 years, if risk-free rate itself is let's say some 10% now, market interest rates have increased. Now as on today, my required return won't be 16%, it will be higher than that. Let us say it is some 18% or 19%, right? Now if I talk about a similar project, if I evaluate a similar project right now, I will not be using a discounting rate of 16%, I will be rather using 19% or 18% as discounting rate. A project which gave me a positive NPV with 16% discounting rate may not give me a positive NPV when I use an 18 or a 19% discounting rate. That means higher the discounting rate you apply, the chances are the asset is not capable of giving back your returns. So the asset is failing or falling short of giving your desired return. The asset might have lost its value in your eyes in the light of increased interest rates. So for that financial management angle, you have to check interest rates increase as an indicator as well. Next one, adverse changes in the market relating to demand, technology and government policies. Suddenly the product the demand of our product has fallen down, or technology, a huge change has come. Because of that, our entity is losing sales. Government actions, government policies, or there are restrictions on exports or imports. Because of that, our sales are significantly affected. See, whenever our sales and profits are significantly affected, the value of assets also will fall down. See, the value of anything is as good as the income it generates. So, for example, you are a CA, you feel that you are very valuable because you are paid well. Because you are paid well, our course is also highly valued. Similarly, if your business sales are high, if your profits are high, then the assets value also is high. But if your income, sales and all are falling down because of some external reasons, there is every chance that asset values also might have fallen down. So therefore, go and do an impairment check. Next, the market cap of the entity is lower than the carrying amount of the net assets. Market cap means what? Market cap means, so for example, equity, share capital, other equity, so many assets, so many liabilities. Now, you are having 1 lakh shares overall. This 1 lakh shares has got a market value of, let us say, 25 rupees per share. So, your market cap of the company is 25 lakh rupees. That means 25 lakh rupees is the value of the company from market point of view. Now, when I compute the carrying amount of net assets in the balance sheet, I do all the assets minus all the liabilities. I am having an amount of 30 lakh rupees. What it means is, when the company gave a balance sheet at the latest year end, in the balance sheet, the book value of net assets itself is 30 lakhs. The company itself told that my assets minus liabilities is 30 lakhs. But the entire market value of all the shares put together is only 25 lakhs. It can mean two things. Number one, the assets are overvalued. That is the reason that becomes an indicator. So when entire shares ka worth 25 lakhs, how can you show assets, net assets of 30 lakhs? That means maybe your assets are overvalued. This is one of the possible reason. Possible reason 2 is assets are correctly valued only, shares only are undervalued in the market. So which one I do not know, but there is a possibility that assets are overvalued. No, that is a reason you have to go for an impairment test now. So that's how this becomes a impairment indicator. These are all external indicators. As you see, in all the external indicators, the impact is coming from a market side. Either substantial fall in the market price, significant increase in the market interest rates, adverse market changes, and market cap of the shares is lower than the book value of the net assets. Sometimes internal indicators also mean something within the entity also can indicate that something is wrong with the asset value. So first, when there has been a physical damage to the asset, suppose there is a short circuit to the factory, because of that an asset got damaged, that's a very clear indicator that asset might have lost its value. Next one, poor economic performance of the asset. You bought the asset assuming that the asset is likely to give you 10,000 units production every month. First 1-2 months it gave, thereafter the production has fallen down by 6,000 units only. So asset performance has fallen down. So that's a kind of indicator that asset is not performing well, therefore it might have lost its value. The entity has entered into any restructuring program or discontinuing operations. Restructuring program means a change in the way in which you conduct your business or changing the scope of the business. So these restructuring, discontinuing operations, who will do? Sir, companies who are not performing well. So you are not performing well means indirectly your company is already into losses or something. For that, you want to change the manner in which you are doing business, or you want to change the scope of the business. Restructuring, same meaning as that is there in India's 37. Discontinuing operations, you decided to stop a particular segment of your business, or a particular business out of your so many businesses of the company. So the assets relating to that may have lost their value. So therefore, this is you have to do an impairment check. So these external and internal indicators may force you to go for impairment test. Now, in the same context, there are 3 scenarios where you have to do a compulsory impairment test every year. Compulsory impairment test ka meaning is, I don't care about the indicators. Even though indicator is not there, you still have to perform impairment testing every year. This we have just now discussed in some other standard. There are 3 scenarios for compulsory impairment testing. Number 1, the goodwill case. intangible asset having indefinite life, and intangible asset under development. In these three cases, definitely you have to go for a compulsory impairment test. Indicators, you need not wait. Intangible assets under intangible assets having indefinite life. When life is unlimited, how will you do amortization every year? Not possible, no? So you have to go for a compulsory impairment test. Intangible asset under development is that case where all the 6 conditions are continued to be demonstrated that they are satisfied and all that case. So the standard wants to double check whether you have capitalized correct amount or not. So apart from giving you 6 conditions, even if you pass all the 6 conditions also, ultimately you have to do a impairment check in the balance sheet. Finally, the last item is goodwill. See, under normal accounting standards, there is a discussion that goodwill should be amortized over a period not exceeding 5 years. Accounting standard 14. Okay, but under India's regime, there is nothing called as amortization of goodwill. We do not amortize goodwill like that. So, whatever goodwill that comes in a business combination transaction, that will sit in the balance sheet and it will sit forever. Because there is no amortization. But because there is no amortization, every year you have to go and do a compulsory impairment check, irrespective of whether indicators are existing or not. So, how to do that and all we will see subsequently. So, coming back. So, if any of these indicators are there, external indicators or internal indicators, then the company will go and do impairment testing. Impairment testing means whatever you are seeing on the screen, that working out FELCTS, working out value in use, between these two, identifying the higher amount called as recoverable amount, compare carrying amount versus recoverable amount. In case carrying amount is more than recoverable amount, then only there is an impairment loss. Now, what is the treatment of this impairment loss? Now, impairment loss should be transferred or debited to PRL. Directly throw it in PRL. However, if your asset is having any revaluation surplus against it, then impairment loss must be first adjusted to revaluation surplus. Any further loss only will go to PRL. So, let us put it like this. So, impairment loss will be first adjusted to revaluation surplus, if any. If there is no revaluation surplus or you have exhausted your revaluation surplus, still impairment loss is there, then such amount will go to your P&L account. First part, not the OCI part, PRL section. So, this is the treatment. Now that we spoke about revaluation surplus, why will an asset have a revaluation surplus? Only when the asset is maintained under revaluation model. Sir, when the asset is maintained at revaluation model, the asset naturally appears at fair value, no? So, or amount which is near to fair value, do I need to do impairment? So, this is a very good question indeed, because you see, suppose I have a plant which is maintained under revaluation model. So, if 5 lakh rupees is the carrying amount, but this is also the fair value, right? Because asset is maintained under revaluation model. Now, there are indicators for impairment. Now, since the asset is already fair value, it's already appearing at correct value of the asset. So, do I still need to do impairment test? See, the answer is like this. In computation of recoverable amount, I have to compute FELCTS and value in use, whichever is higher. Right. Now, imagine your cost to sell is significant. If cost to sell is significant, then FELCTS number when I compute will be definitely and significantly lower than 5 lakh rupees, isn't it? Suppose the cost to sell is 40,000 rupees. Then fair value is 5 lakhs minus 40,000, so it's 4,60,000. Let us say value in use is 4,20,000. So FELCTS gets selected and the carrying amount of the asset is higher than FELCTS. So even though the asset is maintained under revaluation model, asset is appearing in the balance sheet at fair value, if indicators exist, do I need to do impairment testing again? The answer is yes, if cost to sell are significant. If cost to sell is insignificant, very nominal amounts are, So if you compute FELCTS with nominal amount also, FELCTS obviously will be lower than FE only, fair value. So compare, when you do, FELCTS will be lower only any day. But you need not do that, provided the cost to sell is insignificant. If cost to sell is immaterial, very small amount, then don't take the trouble of doing impairment testing, even though indicators are there, because asset is already appearing at fair value, which is broadly a correct recoverable amount only. Of course, cost to sell, if it is insignificant amount, you can ignore. But if cost to sell is significant, then you have to do impairment testing. Mind you guys, just because I'm doing impairment testing does not mean that impairment loss is imminent. It may come, may not come, because what if this is 5,20,000? Your FELCTS will be lower than fair value, but what is value in use if it is higher than your existing carrying amount? Then ultimately there is no impairment loss. But there is a possibility of impairment loss, and for that purpose we have to go and check. So when assets are maintained under revaluation model, if cost to sell is insignificant, then you need not do any impairment checking. Impairment testing is not required. But if cost to sell are significant, then definitely you have to do impairment test. I hope I'm clear. Next one. Now coming to little conceptual small points. This standard is not applicable for the following assets. Inventory case standard is not applicable because you have Ind AS 2 where the measurement principle is cost or NRV, whichever is lower. That means there is an inbuilt impairment check system in Ind AS 2. Trade receivables already Ind AS 109 covers. Any loss allowances are there. Ind AS 109 deals with that. Impairment losses on financial asset, 12-month ECL, lifetime ECL. We discussed that in Ind AS 109. Agricultural assets, not a problem because biological assets and all are measured prima facie at FELCTS, or even on subsequent measurement on the balance sheet date also, they are measured at FELCTS. Deferred tax asset is covered by Ind AS 12. Any other financial assets are also taken care of by Ind AS 109 only. So these are all the scope exclusions. So if you read it positively, the standard is mainly applicable for PP, capital work in progress, investment properties, intangible assets under development and goodwill, investment in shares of subsidiary, associate and joint venture. Investment in shares of subsidiary, associate, joint venture, though are satisfying the definition of financial assets, they are scoped out from Ind AS 32 and 109. Therefore, if there is any impairment in such investment, that is still covered by Ind AS 36. So how to compute impairment loss, all this we have already discussed. Now, next question is, do we need to compute FELCTS and value in use both? So, such a stupid question because the recoverable amount is higher of these two. No? So, general thought is we have to compute both, select the higher number. But look at the case. Suppose I have a carrying amount of 500. Impairment indicators are there. I have to work out recoverable amount. Let us say I worked out FELCTS. That itself came as 600 rupees. So that means you computed one component, either FELCTS or VAU, one number you computed, and that number itself is already higher than your existing carrying amount. Definitely impairment loss will not come. Impairment loss will come when CA is more than RA. But if any one component of RA, let it be FELCTS or FEL or VAU, if it is higher than the carrying amount, definitely you will not have a impairment loss. So you need not compute the other one. This is one case. Second case is impracticability situation. That means the asset is highly complicated asset, it's highly customized kind of equipment or something for which market of immediate fair value determining is difficult. VAU we can compute. So when fair value cannot be computed, then you have to accept, means it is reliably fair value cannot be measured for a particular asset because fair value is a market based number. No. So if fair value cannot be reliably determined, so we may ignore it and accept value in use only as the recoverable amount and proceed ahead. Any one of the number computation is impracticable, then we'll go ahead only with the other output, which is either VAU or FELCTS, whatever you can work out. Next one, you have reason to believe that the FELCTS and value in use, they both are almost near. This usually happens when the asset is likely to be sold in the near future. When asset is likely to be sold in the near future, so let us say an example, let's take a numbers like this. Suppose you are here, you believe that asset is likely to be sold within the next 1 year or something like that. So when I say today FELCTS is 500 rupees, after 1 year ka FELCTS also will be nearly equal to 500 rupees because in 1 year big change will not come. Or even if you say that it is lower, it is at 450 only, after 1 year. But for the next 1 year, I will be using the asset now. Because of that, some cash inflows will come. So these are the expected cash inflows if I use the asset for another year. So if you discount it to today, the present value, which we will call it as the value in use, that and 500 rupees, which is FELCTS as on today, it's likely that both the numbers are almost same. So in that case, whatever FELCTS is today is there, that only you will accept it as a recoverable amount as well. So this is one thing. Now, value in use. See, what is value in use? You take the cash flows from the asset for the remaining life of the asset minus any directly related cash outflows. Consider salvage value of the asset. The net cash inflows, whatever are there, that net cash inflows you discount it to today. That present value only we are calling it as value in use. Now, in determination of this value in use, which cash inflows you can consider, which cash outflows you should consider, which cash flows you should not be including, and what discounting rate you have to apply, all the detailed discussion is there. So let's see. The cash flows should include cash flows from the continuing use of the asset from the existing condition of the asset. So let's say you have an old plant and machinery. So this old plant and machinery in its present condition, what cash flows it can generate, consider only those cash flows. If you say that, sir, if I go for a major overhauling on this asset right now, then the asset is capable of giving me improved cash inflows in future. So, and I am having plans of doing major overhauling expenditure on this asset. So, for determining value in use, future cash inflows, I want to take improved cash inflows. The standard says no. Whatever is the existing condition of the asset. In this existing condition, what cash flows is the asset capable of generating? Consider only those cash flows only. Do not consider the impact of any restructuring or modifications to the asset unless the entity is committed to it. That means you must have already paid the advance to some vendor for doing the overhauling expenditure or something like that. You must show your active commitment for restructuring. If you show that, then definitely improved cash flows in future can be considered for determining your value in use. Do not consider impact of any improvement or restructuring of the asset unless the entity has committed for it. So you want to use the asset in a different way, therefore different cash flows are going to come in future. So I want to consider that. You can consider that provided you prove that you are committed to the plan of restructuring the asset. Otherwise, existing condition. Deduct cash outflows necessary to be incurred to generate the cash inflows. It's pretty straightforward. Net salvage value on the disposal of the asset at the end of its useful life, that also is okay. And exclusions, you see, interest expense, interest income should not be considered. No financing cash flow. Sir, I borrowed money, and with that borrowed money I purchased an asset. So on this borrowing I am paying interest every year. That interest should not be deducted, friends. Don't deduct finance cost in determining the worth of the asset. Similarly, tax impacts also don't consider. Sir, X amount of cash inflow is there, Y amount of cash outflow is there, net cash inflow is this, X minus Y. On that you have to pay tax. No sir, tax also I will remove. Don't remove the tax. Do not consider tax effect. So this is about your determining future cash inflows and future cash outflows. What can be included, what cannot be included. Next one, discounting rate. Now how all these numbers are to be discounted to present value. Always remember, sir, in any valuation throughout your AFM also, or financial management also, everywhere the discounting rate, the first priority is always required return from the asset. Required return means risk-free rate plus certain extra return for taking the risk involved in the asset. So you have to consider a pre-tax rate, because cash flows are before tax. Discounting rate also should be before tax, covering basic time value of money, which is nothing but RF, and some extra return for riskiness of the cash flow. This is nothing but something similar to your capital asset pricing model rate. CAPM formula, if you remember, RF plus beta into RM minus RF. For asset also you can work out. There is asset beta concept in your portfolio management, if you remember. So that should be the first priority. If you don't have that, or you cannot work out required return for your asset, then second priority you can use your weighted average cost of capital. That is also not there. Any other borrowing rate you can use, means your incremental borrowing rate. If I have to borrow extra 1 rupee from the market, at what rate I can raise that money. So in the order of priority, required return, weighted average cost of capital, or any other borrowing rate applicable for you in the market. So this is about your value in use. Now sometimes, sir, your asset generates cash flows, but those cash flows are not in your functional currency rupee, but they are in foreign currency. That means your future cash inflows are there, but their future cash inflows are there in dollars or pounds. But your functional currency is rupee. So asset ka carrying amount is in rupee, but the cash flows from the asset are in some other currency. In that case, how will I do? The easiest way to solve this kind of situation is, all your future cash inflows are in dollars, discount all of them to today using foreign currency discounting rate. So you will get value in use, the present value, also in dollar terms. This value in use, which is the present value, which is in dollars right now, convert that into your rupee currency using today's spot rate. That's the easiest way to achieve value in use when cash flows are arising in foreign currency. This is nothing but foreign currency approach, what you learn in international financial management, portfolio management, in your AFM subject. Don't sit and convert each future cash inflow into rupees like that. Rather, discount all your future cash flows to today, get the present value. The present value is value in use, but that is in dollar terms. Directly apply today's spot rate and convert that into rupee currency. Right. Next one. This one already covered. When asset is maintained under revaluation model, do I need to do impairment? The answer is yes, if the cost to sell are significant, otherwise not required. Next, liabilities in determining recoverable amount. Now you see a simple example. See, I have a nuclear power plant whose life is another 20 years from today. Since it's a nuclear power plant, at the time of installing this or making this power plant, I had a legal obligation to decommission this plant at the end of its useful life. Therefore, provision for decommissioning liability is also created for this asset when we initially capitalized the asset. So on the asset I am providing depreciation, on decommissioning liability I am doing unwinding of interest cost every year, like that. Now, today there is indicator for impairment. If there is an indicator for impairment, I have to compute FEL, CTS and value in use. While determining FEL, CTS, you understand, sir, I cannot sell only the power plant. Whoever buys the power plant from me, that fellow is, let us say, legally supposed to take over even the obligation for decommissioning liability also. It won't be like I sell off the asset right now to somebody, but after 20 years when the life of the asset is over, I go and decommission it. No, I will sell both of them together. So the FEL, CTS, whatever I am getting, that number is not for the power plant. It's for power plant net of the liability. So FEL, CTS, let us say I got 800 lakh rupees for asset and liability put together. So in this case, where you should be very careful is when you are determining, imagine VAU also I computed. This is obviously, let us say this is some 700 rupees. So higher one, this only got selected. Therefore, your recoverable amount is 800 rupees. Right? Now, I want to know what is the impairment loss. So what you should do is, take the carrying amount of the asset. Let us say this is 1400 rupees. This is 500 rupees. So, carrying amount is equal to 1400 minus 500, which is equal to 900. This versus recoverable amount. You cannot take only the carrying amount of asset ignoring the liability, because your recoverable amount itself is determined considering the decommissioning obligation, right? So therefore, carrying amount also should be determined after netting off the decommissioning liability. So this 900 rupees net carrying amount should be compared with your recoverable amount. Okay, sir, I compared. Now what? Now what? Carrying amount is definitely higher than the recoverable amount. Therefore, you have a impairment loss. Sorry, impairment loss, what should you do? What will you do? You have to go and adjust this impairment loss against your plant and machinery and correspondingly debit it to your P&L account. Of course, you have a revaluation surplus, you can adjust it to revaluation surplus. Never ever give impairment loss adjustment for a liability. Impairment loss has to be adjusted only for the asset. I compared net amount because your recoverable amount is not for the gross asset. Your recoverable amount is for asset and liability. Therefore, to identify correct amount of impairment loss, carrying amount also should be for the net asset. Asset minus its a related liability. That's all. I don't intend or I don't presume that loss will be adjusted to the liability. Don't do that. It's an important stuff, guys. So these are indicator story. This is okay. Now coming to the next very most important concept in India statistics, the concept of cash generating unit. Now you see, if you have to determine value in usage, value in use, then the future cash flows of the asset must be discounted to today. That means the asset should be capable of generating some cash flows. Now, for example, there is an air conditioner here, there is some lights here, there is a projector lamp here. All these are assets only. They're definitely part of my office equipment. Are they generating cash flow, each one of them? Is the camera which is recording me, is it generating cash inflow? Can I estimate what cash flow does the camera generate? What cash flow the projector generates? What cash flow this iPad generates? I cannot work out cash flow independently like that, because these assets on its own are not capable of generating cash flows. Suppose you take a truck, you take an aeroplane, they are capable of generating cash flows substantially independently. But when you take a classroom studio like this, there are so many equipments here, none of them are capable of generating cash flows on their own. But all of them put together, put to a particular use, is capable of generating cash flows. So if I have to do impairment testing on any asset, the asset must be capable of generating independent cash flows. When asset is not capable of generating independent cash flows, I cannot be in a position to determine its value in use, because asset does not generate any cash inflows. In that cases, instead of testing that asset for impairment, we will test the entire cash generating unit of that asset. Now the definition of cash generating unit is CGU, or cash generating unit, are smallest group of identifiable assets which are capable of generating independent cash flows. Your single asset may not generate cash flows, but this asset plus some other asset plus some other asset form a smallest group, as small as possible, which is capable of generating independent cash flows, and go and subject that particular group for impairment testing and not for this individual asset. Now this entire concept of cash generating unit, we'll take up a small example and try to understand from that. Suppose there is machine A and then there is machine B. So machine A and machine B are kind of an interdependent kind of assets. So machine A gets the raw material feeding. It converts this into one WAP. This WAP is processed by machine B. Here finished goods will come. These finished goods are sold. Just I'm telling you, the WAP of machine A has no active market. Okay, so A cannot generate any cash flows on its own. B also cannot generate any cash flow on its own, because it is dependent on machine A for its raw material input. But A plus B put together is definitely capable of converting raw material into finished goods, and it can be sold and cash inflows can be generated independently. So these two put together is a CGU. Now imagine there is a small short circuit here on one of the asset. So physical damage to an asset is an indicator for impairment. Since physical damage to an asset is an indicator for impairment, I have to go and do impairment testing on machine A. But machine A is not capable of generating independent cash flows. So I am forced to test the cash generating unit CGU of A plus B for impairment, rather only machine A. Now, so let us say carrying amount of machine A, let us say, is 300. Carrying amount of machine B is 200. So the carrying amount of entire CGU of A plus B is 500 rupees. Combinedly, they are capable of generating future cash inflows. No? So you can work out the recoverable amount. VAUs can be worked out. A plus B, if you sell it off in the market, how much you can get, that also you can work out. So which is higher of FELCTS and value in use. So let us say I got 400. So definitely carrying amount is higher, there is an impairment loss. This impairment loss 100 rupees should be allocated to the assets in the CGU proportionately in the ratio of their carrying amount. So which means so let us say if I am having A, B, two individual assets, their carrying amounts are 300 rupees, 200 rupees. Impairment loss 100 is allocated in the ratio of 3:2. So it will be 60 and 40. So this is how you do impairment testing on a cash generating unit. So first you club both of them, treat entire group as a single asset, work out the recoverable amount for this entire group CGU, compare CA versus RA. In case CA is higher than RA, the excess amount is impairment loss. That impairment loss should be borne by all the assets in the CGU proportionately in the ratio of their carrying amounts. It's a plain case. Now consider this extra information. Same stories, I'm not changing the numbers, I'm just giving you some additional numbers, that's all. Same thing. Just imagine what if you are having a FELCTS of A at 220 or let's say 210 and FELCTS of B at 180. See, I may not be in a position to work out value in use for each one of them, but if I sell A in the market, if I sell B in the market, somebody else can buy, no. So effectively FELCTS I may be in a position to work out. Now on its own, B ka value is 180 rupees if you sell it. Carrying amount is 200. Value in use I do not know of B alone. I'm not talking about A, sir, I'm talking about B. Okay. B ka value in use I do not know. B ka FELCTS I know 180. B ka carrying amount is 200. You should not say that B is overstated because you do not know value in use of B still. Okay. So when I did impairment loss allocation and all, the carrying amount of B has come down to 160. 160 is a number which is lower than its own FELCTS. B is at least capable of having a value of 180 rupees, no, but you dragged B to a value which is lower than 180. That is not right. In this case, B on its own at least has a value of 180 rupees. When on its own it is having a value of 180 rupees, you cannot drag it below that individual recoverable amount of each asset. So even though the primary rule is allocate impairment loss to all the assets in the CGU in the ratio of carrying amount, you must also ensure that no asset in the CGU goes below its own recoverable amount. If own VAU, own FELCTS can be worked out, no, it should not be lower than that. So you should do allocation like that. Now, since we reduced it below 180, what you have to do is reallocate. So how much extra did you give it back? 20, you put it here. That 20 you adjust here. So like that. So even though prima facie you allocate some impairment loss to an asset, you must ensure that after allocating that impairment loss, the asset should not go below its own individual recoverable amount, or it should not become negative also. So guys, this is it. Sir, what about A? Can A take any amount of loss? Not always, sir. Now you see here A ka VAU also I do not know, but A ka FELCTS is 210. So its current carrying amount is 300. So from current carrying amount of 300, I can maximum reduce it down to 210, not beyond that. So here after reallocating the impairment loss, this fellow's carrying amount is 220. 220 is still okay. But in no case I can reduce it below 210. I can reduce it below 210. Sir, what if you say that, let me put this case like this only, let me take another number. Another scenario, AB 300, 200, 60, 40, just like how we did the previous allocation, 240 and 160. Own FELCTS of B is 180. Here FELCTS on its own is 230. So A is saying that I do not know my VAU, but my FELCTS at least is 230. You cannot drag me below 230. So when you do prima facie impairment allocation, A you reduced it to 240, so A is happy only, but B you reduced it below its 180, so B is not happy. So reallocation when you do, here you will add back 20, here you will minus 20. So this is 180. So now B is okay, but A has been reduced to 220. A says that my own value, my own FELCTS is 230. How can you reduce it me to 220? This is wrong. So what you will have to do is you have to add back 10. If you place 10 rupees back there, now who will bear that loss? The answer is nobody. So certain impairment loss is ignored. So if you observe 230 plus 110, 230 plus 180, it is not 400, it is 410, which is higher than the recoverable amount of the CGU, and that is okay, because individual assets cannot be reduced below its own FELCTS or own VAU, or they cannot become negative in any case. So this is how you do allocation of impairment loss in a CGU. It's a good concept, guys. You have two applications on this. So all these concepts are given here. Next, coming to impairment testing for a goodwill. Very important, extremely important. Listen guys, first of all, when will goodwill come? Imagine your company is X Limited. Your company is into cosmetics business. So you have CGU 1 and CGU 2. You are making two your products, some cream, some lipstick, something like that. So here there are two CGUs. In CGU 1, you are having X and Y, two machineries are there. Here A and B, two machineries are there. So presently this is your business. You are doing cosmetic business. Now X Limited acquired Y Limited. Let us say PC paid is 1000 lakhs or 1000 crores. The fair value of identifiable net assets in Y Limited is 800 crores. So you paid extra consideration of 200 crores. This extra consideration only we are calling it as goodwill. So even though the identifiable net assets in Y Limited is 800 rupees, you paid PC of 1000 rupees. The extra amount, whatever you paid, that amount will recognize in the balance sheet as goodwill. Now, because you acquired Y Limited now, another CGU also joins your business, CGU 3. Because Y Limited law assets and liabilities also will come now. In that, one CGU is there. Let us identify P and Q assets are there in this CGU. Now imagine, sir, think very practically. When visible net assets are only 800, but I paid 1000 rupees for acquiring that business. That means the extra cost I incurred is 200 rupees. When I spend 200 rupees extra like that, I definitely know why I am paying that extra 200. The extra 200 cost, whatever I am incurring today, that I will recover it in the form of additional future economic benefits in future. Now these benefits, from where they are going to come, that management definitely knows. When I am paying something extra and I am buying you, I extra, how will I recover? Don't I know that? Definitely I know. If I do not know that, I am not stupid to pay additional amount and buy your business today. Okay, so definitely the management will know from where that 200 rupees ka benefit will come in future. It can be from CGU 1, it can be from CGU 2, it can be from CGU 3. Maybe Y Limited is having some branded product. That branded product ka brand, if I use for CGU 1 and CGU 2, then the sales of CGU 1 and CGU 2 also will boost up. That's the reason I paid extra 200. In that case, extra 200 crores, whatever I paid today and reflecting in the balance sheet as goodwill, the additional benefit will be recovered, the additional cost will be translated into additional benefits in future arising from CGU 1 and CGU 2. Or you may believe that the company has brand and all, but with my management now, the sales of P and Q will boost up. That means you may believe that this goodwill extra amount 200, whatever you paid, the benefit is going to come in future only from CGU 3. Or it can be from 2 plus 3, or it can be plus 1 plus 2 plus 3. So the management will know. This will be given in the question, sir. You need not bother about this. So, first thing, management should identify goodwill to CGUs. I am not saying go and allocate it. Rather, I'll use another word, attribute. Because the management knows, because the management only paid extra consideration, management will definitely know extra money paid is going to be extracted from which CGUs. The synergy benefit is going to come in which way, the management knows. So definitely the management has to attribute goodwill to certain CGUs, sometimes all the CGUs also. Now, after you identified, let us say you said in this case that goodwill belongs to CGU 1, CGU 2 and CGU 3. You need not include all the 3 CGUs, sir. You can include only one CGU also, that's also fine. 1 plus 2, 2 plus 3, 1 plus 3, only 3, anything is okay. Just for discussion sake, I am taking all the 3. Okay, goodwill belongs to all the 3 CGUs. Next question is, goodwill can be allocated to individual CGUs. You are saying that 200 rupees goodwill, whatever you have in your balance sheet, that goodwill belongs to CGU 1, CGU 2, CGU 3. Benefits will come in future from 1, 2 and 3. Fine. Do you know how much benefit will come from 1, how much benefit will come from 2, how much benefit will come from 3? Are you having such detailed information with you? If you have, then our calculation will proceed in a particular way. If you cannot do that allocation, then another way is there. So, let us first proceed with this. Goodwill can be allocated. So, you are saying that I have CGU 1, I have CGU 2, I have CGU 3. Here X and Y assets are there. Here A and B assets are there. Here P and Q assets are there. Some carrying amount I am randomly taking, sir. X and Y put together, A and B put together, P and Q put together. Some randomly some numbers I am taking. To this add goodwill. Sir, how should I allocate? Listen, this goodwill, how much benefit will come from each? How will I know? I do not know. The management has to know this. If the management knows this, this is how we will do it. In the examinations questions, so they will give you. Don't worry. So this goodwill, 200 rupees, whatever I am having, Let us say I'm allocating like this 80, 70 and 50. So this is 1080. This is carrying amount of the CGU including goodwill 670, 350. Gross carrying amount including goodwill of the CGU. Compare this with the recoverable amount. Let us say recoverable amount is 900, 620. Here it is 400. Compute impairment loss. Impairment loss is 180, impairment loss is 50, impairment loss is 0. Now what is the treatment of impairment loss? Impairment loss treatment, look at this sir. Impairment loss will be debited to P&L account basically. Okay. Or if you are having revaluation surplus, you will adjust to revaluation surplus first and subsequently debit to P&L account once you exhaust entire revaluation surplus with your impairment loss. Now my point is, okay, that's a debit part of the impairment loss. Credit where impairment loss will be used to reduce which assets. So impairment loss, first write off goodwill, then other assets in CGU. So first go and kill goodwill. 180 rupees loss is there. So 180 rupees loss has to be booked in CGU1. CGU1 ki goodwill attributed is 80. First kill off this 80 goodwill. Further 100 rupees loss is there. That 100 rupees loss is allocated to CGU1 assets. Who are CGU1 assets? X and Y. Now coming to CGU2, the loss is 50. But goodwill attributed is 70. So entire 50 rupees loss will be used to write off goodwill only. Nothing against other assets in the CGU. Here there is no impairment loss, no issues. This is how you will do goodwill ka impairment testing every year. We already know goodwill has to be compulsorily subject to impairment testing every year. That goodwill impairment is done like this. So that depends on whether you can allocate goodwill to your CGUs or you cannot allocate. If you can allocate, this is how you will do. Sir, what if goodwill cannot be allocated? See guys, if goodwill cannot be allocated to individual CGUs, you are saying that I know that goodwill belongs to CGU 1, 2, 3, but I don't know how much from 1, how much from 2, how much from 3. That individual allocation you do not know. Attribution you should know obviously, but allocation you do not know. So in this case, you have to apply two steps. Step number 1, do impairment testing at individual CGU level if indicators exist. Fine, forget about goodwill now. Go and check CGU1, CGU2, CGU3. Are there any indicators for impairment? If there are any indicators for impairment, go and do impairment testing on such CGU, CGU1, CGU2, CGU3. Forget goodwill. Normal, take the remaining assets ka carrying amount versus its recoverable amount. Whatever impairment loss is there, go and book in case impairment loss is there. Now, as a principle in the standard, this is important, sir. If indicators exist, only you will go and do. But there are questions in your study material and past examinations where they will give you carrying amount of CGU1, CGU2, CGU3, recoverable amount of CGU1, CGU2, CGU3, but the question will be silent whether individually indicators are there or not there. In that case, what should I do? Go and see if carrying amount is higher than recoverable amount of any CGU. If any CGU ka carrying amount is more than its recoverable amount, you presume that indicators are there and go and book impairment loss on that CGU. Forget about goodwill. Forget about goodwill. Goodwill, how to catch? Step number 2, we will see. But step number 1, when you are testing individual CGUs for impairment testing, ideally you should do that only when indicators exist. So if there are no indicators individually, you should not be doing any impairment testing on individual CGUs. Step number 1 is not applicable for you at all. But in the examination question, in ICS study mat questions and all, if the question is silent, but there are 3 CGUs, each CGU ka carrying amount, when you compare it with the recoverable amount, it is possible that 1 or 2 CGUs carrying amount is higher than the recoverable amount. Presume that there is an indicator for impairment and go and book the impairment loss on those CGUs in step number 1. The examination points are not a standard conceptual point. Now coming to step number 2. Do impairment testing on group of CGUs. Sometimes this itself also becomes entity level impairment test. Meaning, you will take the carrying amount of CGU1, carrying amount of CGU2, carrying amount of CGU3, add all of them. So whatever amount you are having, random same numbers I will take, it's 1900, 1000, 600, 300, 1900. These 3 CGUs put together is one big fat CGU. And if all these CGUs only are there in your entity, then indirectly this is the carrying amount of your entire entity itself. To this definitely goodwill can be allocated. I do not know how much for 1, how much for CGU2, how much for CGU3, but definitely goodwill belongs to this big CGU. So whatever 200 rupees is there, add it here. So 2100. So this huge carrying amount, compare it with recoverable amount of your business. So suppose recoverable amount of the business came to let's say it's come to 1950. So there is a 150 rupees impairment loss. First allocate to goodwill. Goodwill amount itself is 200. I have a loss of only 150. Entire amount is allocated towards goodwill. Remaining loss, if any, must be given to other assets in this CGU to the extent they can absorb. That's it. So when it comes to goodwill, you have 2 scenarios, sir. First of all, the management definitely knows goodwill belongs to which CGUs. Okay, that the question has to give you. Next, how to allocate impairment loss or how to determine goodwill impairment loss is like this. 2 scenarios are possible. One, management knows how much goodwill is allocated to each individual CGU. In that case, life is very simple. If goodwill cannot be allocated to individual CGUs, then you have to do 2 steps by impairment test. 1, ignoring goodwill, do impairment testing on individual CGUs. Step number 2, club all the CGUs ka revised carrying amount after step number 1. To that, add goodwill, subject the entire entity for impairment test. That's all. But remember, sir, in this, whatever impairment loss comes, that impairment loss must be first used to knock off goodwill. Once goodwill of that particular CGU is dead, then only you proceed against other assets in the CGU. Now, that's also, this is the story about goodwill. Now, next concept is the story of corporate assets. If you understood goodwill, corporate asset story is similar. Now, corporate assets are, these are assets in the business which do not generate any independent cash flows on their own, but they assist other CGUs in generating cash flows. So, for example, I am having 3 factory buildings. All 3 are factory buildings. They are in the outskirts of the city. In the city, I am having a head office building. All the work is happening in factories. Factories and entire production and all is happening. Sales are directly made from the factory to individual retail stores and all. Now, what are you doing in head office? The core admin work is happening here. Discussion with clients will happen here. Negotiations and all will happen in head office. Various meetings and all will take place. The board of directors will sit there. The accounts department is sitting there. You people going for audit at head office. So, head office is required. But head office on its own, the corporate head office does not generate any cash inflows. But it assists other CGUs. For example, this factory 1, factory 2, factory 3, these are places where group of assets are generating cash flows. Each one of them is a single CGU. So this CGU is able to generate cash inflow because of the assistance provided by head office. So this head office is called as corporate asset. Now you see, Head office or corporate asset ka story does not fit into compulsory impairment test wala case. So you will do impairment testing on the head office only when there is an indicator for impairment. No indicator, no impairment testing on corporate assets. So if any of external or external or internal indicators are there, then only you will go and do corporate asset ka impairment testing. Sir, how will I do corporate asset ka impairment testing? Because head office cannot generate any cash flows, no. So VAU, how will you determine? FELCTS, yes, I can determine. VU determination is not possible, no. Sir, then what to do? Simple, sir. Entire steps are similar to goodwill. So this head office ka benefit is derived by CGU1, CGU2, CGU3. We definitely know that head office ka benefit is enjoyed by all the 3 CGUs. So corporate asset is attributed to which CGUs? I know that. Second question, can you allocate or can you not allocate? So 2 scenarios, just like goodwill. Do you know, suppose the carrying amount of head office building is 1000. So this 1000 ka benefit, how much will you get from factory 1, how much will you get from factory 2, how much will you get from factory 3? If you know, that is one scenario. If you do not know that, that is another scenario, just like goodwill. So in place of goodwill, if I put here head office building, I know how much belongs to each CGU, so nicely allocate it. Go and get the big carrying amount, compare that with the recoverable amount, identify the impairment loss. Once you get the impairment loss, because goodwill is a least trusted, cannot be identified asset, we first killed goodwill here. But head office building is not an unidentifiable asset like goodwill, no. So you should not first kill head office building like that. So what you should do is this 180 must be allocated to head office building also, X also, Y also. Who is X and Y? CGU1 la whatever assets are there. So 180 rupees loss must be given to all the assets in the CGU proportionately. You should not go and first knock off corporate asset like how you killed goodwill. Process is same. Ultimate allocation of impairment loss. Now, if it is goodwill, first you knock off goodwill. But if it is corporate asset, you should not knock off corporate asset first. You should treat corporate asset like any other asset in the CGU. So proportionately allocate loss to all the assets in the CGU. So this is which case when corporate asset can be allocated. If you say corporate asset cannot be allocated, then again you have to do 2 steps. Step number 1, impairment testing of individual CGUs, ignoring corporate asset. Step number 2, group of CGUs you club, treat them as one single fat CGU. To the definitely corporate asset head office building can be added. Add that, one big carrying amount of the entire CGU, entire entity will come. Compare that with the recoverable amount. In case here also you get impairment loss, allocated to all assets in proportionately, including corporate asset. So corporate asset is not the first priority of killing and all. Goodwill we kill like that because goodwill cannot be proved, verified, sold, cannot be identified. So given a chance, first you will knock off goodwill. But when you are talking about corporate asset, you will not do like that. So guys, that is all about a corporate asset. So goodwill and corporate asset ka impairment loss determination pattern is same, but allocation lo difference is there. There is one concept related to goodwill of subsidiary that we will discuss when we do questions on these concepts later on. So goodwill impairment testing is covered, sir. Corporate asset impairment testing is covered. Now coming to reversal of impairment loss. Guys, this is the last concept in our impairment discussion. See, when indicators are existing, you went and did impairment testing and you got impairment loss. Impairment loss, you booked it, reduced the value of the asset and all. Subsequently, if there are any indicators for reversal, that means there's something is indicating that the value of the asset have increased. So whatever impairment loss you booked once upon a time, that has to be reversed now and the carrying amount of the asset has to be increased. So impairment loss is reducing the carrying amount of the asset. Reversal of impairment loss is increasing the carrying amount of the asset. This you can do only when there are indicators for reversal. So like there are reversals, indicators for impairment testing, like that reversal indicators also must be present. Now the question is, sir, how much can I reverse? How much impairment loss can I reverse? So you have two cutoff points, sir. After reversal of impairment loss, carrying amount of the asset shall not exceed, number 1, deemed carrying amount of the asset if there was no impairment loss. Had you not provided impairment loss at all, today what carrying amount would have been there? That's a maximum point you can reach from your existing carrying amount. Post reversal, this is a maximum amount you can reach, deemed carrying amount, if there was no impairment loss in the first place. But at the same time, you cannot exceed your recoverable amount. So even at the time of reversal of impairment loss also, you still have to work out recoverable amount, ensure that the carrying amount should not cross the recoverable amount, because today you have some existing carrying amount, you want to increase it, but that increase should not take the asset beyond its recoverable amount today, because again it will become overstated. So let's see this with the help of a small example. Suppose the original cost of the asset is 10 lakh rupees with a life of 10 years. So let us say provided depreciation for a period of 3 years. So 10 lakhs into 3 by 10. So 3 lakh rupees depreciation I have removed. So carrying amount at year 3 ending. At this time there are indicators for impairment. Since there are indicators for impairment, I determined recoverable amount. Let us say recoverable amount came to 4,90,000. So carrying amount is definitely higher than recoverable amount. So I book impairment loss of 2,10,000. So after booking impairment loss, revised carrying amount is 4,90,000. So let us continue story for another 2 years. So depreciation for 2 more years. 4,90,000. 10 years life already, 3 years already over. No, so remaining life is 7 years. In that also another 2 years is over. So 70,000 into 2, 1,40,000. So 3,50,000 rupees is carrying amount of asset or carrying amount at end of year 5. Now indicators exist for reversal. When indicators exist for impairment, you did impairment testing, you reduced the value of the asset. Now when indicator for reversal is there, you have to increase the carrying amount of the asset. Now up to what level? Look at this. So first and foremost, you have to determine the recoverable amount. Recoverable amount is VIU, FELCTs, whichever is higher, that recoverable amount you have to determine. Once you determine the recoverable amount, so let us take some recoverable amount. Case 1, let's say 4 lakh rupees. Second scenario, let's assume that it is 5,40,000 rupees. So let's say up to maximum, what can you do? Today's carrying amount is 3,50,000. You have two limit points, sir. One is deemed carrying amount if there was no impairment loss. So originally the asset value is 10 lakh rupees. If there was no impairment loss, I simply would have provided depreciation on this for 5 years till date. So asset ka carrying amount would have been 5 lakh rupees if there was no impairment loss at all. Second checkpoint I have is recoverable amount. Recoverable amount, two cases we have taken. One is assume 4 lakhs, the other one is assume 5,40,000. So here also let's make two cases. Case 1, case 2. So first amount, deemed carrying amount is same, second amount is changing depending on which case you are talking about. So your existing carrying amount is 3,50,000. So when you reverse your impairment loss from 3,50,000, your asset value has to increase. Increase to what value? You have two cutoff points. One, you can go up to your deemed carrying amount if there was no impairment loss. Number two, you cannot exceed your recoverable amount. So how you must understand is both the conditions have to be satisfied. Select the lower amount. So in case 1, even though deemed carrying amount would have been 5 lakhs, I cannot take you to 5 lakhs because your recoverable amount today is only 4 lakhs. So I can maximum raise from 350 to 4 lakhs only. Therefore, impairment loss reversal is from existing carrying amount of 350, you can jump maximum only up to 4 lakhs. So that means impairment loss reversal is only 50,000 rupees. In the second case, I can let you jump up to 5 lakh rupees completely. So from 350, if you jump up to 5 lakhs, 1,50,000 rupees asset value can raise. Of course, impairment loss will be credited to your P&L account. It's just like reversal of whatever you did earlier. That's also. So this is about impairment loss ka reversal. Sir, what if you are talking about impairment loss reversal on not individual asset but on CGU? Even if it is CGU also, same story, same pattern will apply. Only thing is, same rules. Post CGU, existing one carrying amount of CGU will be there. After impairment loss reversal, the CGU ka individual assets are there. No, individual assets ka carrying amount should not be more than deemed CGU or recoverable amount, whichever is lower. So ultimate checkpoints and all are same. Only one small catch point is there. You should be careful there. If your CGU consists of machine A, machine B and goodwill, suppose you got impairment loss. When you got impairment loss, you first went and knocked off goodwill. Then you allocated to machine A and B. This is when you booked impairment loss. Subsequently, when there is a reversal indicator, so the CGU ka value has grown up. With that increased value, you cannot recreate goodwill. Goodwill once gone is gone. You cannot recreate goodwill that is written off. But whatever amounts you have written off towards A and B, that amounts can be restored. Asset value A and B can be increased. But of course, keeping in mind these two checkpoints. The deemed carrying amount of these assets if there was no impairment loss and their today's recoverable amount. Based on that, you can increase the value of A and B, but you cannot restore goodwill that is already cancelled. So guys, that is all about your Ind AS 36 impairment of assets. In this, one small concept of goodwill related to subsidiaries that we'll discuss when we do some questions concept. Very simple one, nothing very great. So guys, thank you so much. It's held for sale and also it talks about discontinued operations. Anyway, let's straight away proceed into that. Like how this is a very simple standard. Like how our Ind AS 36 has certain scoped out items, here also Ind AS 105 is applicable for all the non-current assets, but it's not applicable to DTAs. Financial assets are not covered under the scope of the standard. Inventories are scoped out from Ind AS 105, and any non-current assets that are already measured at FEL CTs like your biological assets and all, they are also not covered. So straight away we are talking about scoped out items. Now, even though the title of the standard is non-current assets held for sale, that means your plant and machinery, PPEs, intangible assets, investment properties, all these are covered under the standard. Goodwill is covered under the standard. So non-current assets held for sale are definitely covered under the standard. Now, even though the title of the standard is non-current assets held for sale, is standard also deals with non-current assets. Anyway, it deals non-current assets which are held for sale. It also deals with disposal group that is held for sale. Disposal group means it is a group of certain assets and liabilities which are expected to be sold in a single transaction. So maybe a particular CGU is there. Is CGU is supposed to be disposed of in a single transaction. So in this group, disposal group, there can be non-current assets like your PPE, intangible assets, goodwill, investment property and all. But there can be some other items like your investments can be there, debtors can be there, some inventory can be there, scoped out items also can be forming part of that group. In fact, even a bank loan, a creditor also may be a part of that particular group which is held for sale. So disposal group held for sale is definitely covered in the standard. But when we go into the standard and read all the provisions, we will understand that Ind AS 105 is applicable only for the non-current assets which are included in the disposal group. So while doing all that measurement classification principles and all, we will consider the entire disposal group. But Ind AS 105 principles are applicable only for the non-current asset that are scoped in the standard, which are included in the disposal group. So non-current assets held for sale is covered. Disposal group held for sale is also discussed in the standard, but these standard principles are applicable only for the non-current assets which are included in the disposal group. So that only is given here. A disposal group is a group of assets to be disposed of by sale together as a group in a single transaction, and also may include liabilities that are directly associated with such assets that will be transferred. A disposal group may include non-current assets, current assets and also liabilities. This standard covers only the measurement principle of non-current assets in the disposal group. Even though DG held for sale is discussed in the standard principles are applicable only for the non-current assets. Next, abandonment of any asset does not mean that automatically the asset is classified as held for sale. Look at this. So for example, I have machine A. This machine A will give me an output which is an input for machine B. B output will go to C and C will ultimately give me finished good. So here we are inputting the raw material. Okay. So by the time I buy the raw material and I process that into one WIP, which is here, a WIP1 costing is coming to 100 rupees, 140 rupees per kg. But today in the market, I found a supplier who is giving same quality ka input at 125 per kg. So in your costing, it's just similar to your make or buy decision. If I make the product, it's becoming 145. Buy it from outside, it's costing only 125. So what I did, let us try with this supplier for some time. So I stopped buying raw material. I stopped using machine A temporarily, and I started buying the product from the market. What I thought is, let me try this supplier for a period of 1 year. Then we will ultimately decide what to be done with machine A. So as on today, nothing has been decided towards machine A that machine A will be sold and all. But yes, definitely I stopped using machine A actively. So I'm buying the product from the market. Now machine A is set aside now. Since machine A is set aside from active usage, this is called as asset is abandoned from usage. Abandoned does not by itself means that the asset is held for sale. Just because you stopped using a particular asset actively does not automatically classify it as held for sale. But of course, yes, eventually after 1 year, if I'm quite satisfied with the product, what I'm buying from the market, and I find a couple of more suppliers also, I get a comfort that, okay, now I don't need this process anymore. So machine A has to be sold. So when I take that decision and all, at the time again, machine A can be classified as held for sale, but definitely not classified as held for sale today, just because you have decided to not use it actively. So abandonment does not mean that asset is classified as held for sale. Right. Now coming to the next aspect. This is classification of a non-current asset as held for sale. Now you see, sir, there is nothing in a very simple nutshell. If I should tell you, when an asset is classified as held for sale, the standard measurement principles will apply. And in that measurement principles, basically the standard wants you to measure the asset at FELCTS, and the resulting gains and losses will be accounted in your PRL section, P&L account, the first part. So if I have to apply the measurement principles of Ind AS 105, first of all, the asset must be properly identified as classified as held for sale. Now the standard gives you detailed parameters when will we treat that asset is classified as held for sale. Now these parameters are two conditions, sir. Condition number 1. Asset is available for immediate sale or distribution in its present condition, subject to any customary or usual or customary delays which are acceptable. First condition is, let's say I have a building. This building you want to classify it as held for sale. The first condition is the building must be available for sale in its immediate present condition. Whatever condition is there, if a buyer comes with the right price, you should be able to sell it off. The asset is available for sale in its immediate present condition. This is your first criteria. Sir, what is that usually customary delays and all? Look at this. I have a building, guys. It's quite an old building. I have decided to sell it. So I informed couple of brokers and all, get me good party. Once a right price comes, we'll dispose of the building. Next day morning only, one enthusiastic mediator, he got a prospective customer. The customer is standing in front of me. I told the broker that, see, I am very sure that I will sell the asset, but the asset is in a very bad condition. If I show this asset in its present condition to the customer, I will not be able to fetch a good price for my asset. So give me a time of 3 months. Meanwhile, I will renovate the building, small changes I will do, some cosmetic effects I will do. I'll paint the building and then we will put it up for sale. At this stage, I don't even want to show my asset to the market. That means what? You are indirectly saying that the asset is not available for sale in its immediate present condition. Condition number 1 failed. Your asset is not classified as held for sale. Ind AS 105 hereafter is not applicable for you. Similar example, different one. Watch this. I have an apartment which is a non-current asset building. This I have given it on rent. But today I have taken a concrete decision that the asset must be sold. I informed a couple of mediators. So this mediator got me a prospective buyer. So I already informed my tenants that I am going to sell this flat and they should vacate the flat in the next notice period of 2 months. So the 2 months notice period has started. So today broker has come with a customer. I showed the customer the property and I told him that this is the house buy, this is the amount what you have to pay. But in any eventuality, I cannot sell this property right now. I have to wait till the tenant vacates, till the tenant finishes their 2 months notice period. I cannot sell the property. Okay, so this kind of thing is called as usual or customary delays. So I want to sell, but it will take time. That is normal, natural, acceptable. That is okay, that is not a problem. So second case is still you are passing condition number 1. Asset is available for sale, but usual delay will be there. That's normal, natural, acceptable. But the first example where you need some time to renovate it, paint it, do some cosmetic effect on the building, that is not a scene where condition number 1 is getting satisfied. You should be very careful while reading the question information. So this is about condition number 1. Now condition number 2, the sale must be highly probable. Now you see the word probable means when the chance of happening is more than 50%, we use the word probable. But here the language use is not probable, but they are talking about highly probable. Highly probable means it's something more than 90%. Of course, it's not going to percentage and all, just for your understanding I'm saying. But the standard says that we will consider that the sale is highly probable only when 5 conditions are met. Already first condition is there. To fulfill the second condition now, they are asking you to fulfill 5 conditions. So all in all put together, first one, asset is available for sale in its immediate present condition, subject to usual customary delays, condition number 1. Condition number 2, sale must be highly probable. For sale to become highly probable, 5 subconditions are there. 1 plus 5, total 6 conditions you have to satisfy. Now, what are these 6 conditions? Now, you see, first one, whether the management is committed to sell the property or not, whether all the approvals are obtained or not, you have to check. See, for example, you are the finance manager of the company. You have a plant and machinery which the management has decided, means management casually are in talks of selling that asset. That does not mean that as a finance manager, you have a right to go drag that asset to the market and sell it off. Because there need to be, depending on your internal rules, to sell a particular item of equipment, there is a separate authority whose approval is required. Sometimes board of directors ka approval is required, sometimes shareholders ka approval is required. So whoever is that authority who is supposed to give approval, that approval must be obtained. So approval must be obtained. So condition number 1 is that. Next, condition number 2, an active program to locate the buyer and complete the sale plan or distribution plan has been initiated. See, whatever conditions we are studying, whatever drama we are studying, non-current assets held for sale, it is also applicable for non-current assets which are held for distribution to the shareholders. So instead of paying cash dividend to the shareholders, you may want to distribute your non-current assets as dividend to your shareholders. So in that case also same criteria will be applicable. So everywhere we are talking about sale, the word distribution is also coming and disturbing us. We don't have any direct questions on that, but as is the principles are same. Anyway, active program to identify the buyer has been started. That means what? You talking with mediators, you giving an ad in a newspaper, or updating in websites like Magic Bricks and all whatever related websites are there. There, if you update this information, all this is part of step number 2. Step number 3, the asset is marketed for sale at a price that is reasonable in relation to current fair value. Suppose the value of the building is 5 crore rupees, let's say market value. The sale price what you are quoting should be around that 5 crores. No, you cannot quote 8 crores. If you are quoting 8 crores strictly, when the market value of the property is only 5 crores, definitely the sale is not probable. Sale is not likely to happen. The sale is likely to happen only when you quote a sale price which is more or less near to its current fair value. Third point. Fourth point. The sale is expected to be completed within 1 year from today. So if today you want to classify this asset as held for sale, you should prima facie believe that the sale transaction is going to happen within the next 1 year. Sir, I believe you, sir. Today I classify the asset as held for sale. I apply Ind AS 105. 1 year is over, but ultimately the asset is not sold. Then what? The standard says even within 1 year, if the asset is not sold, even then we believe that the asset is held for sale if the reason for delay is beyond the control of the management. Suppose there is a natural pandemic, COVID, something like that has come. Everywhere there is lockdown. So though initially we thought that we'll finish off the sale of the asset within 1 year, that could not happen because there is a lockdown for 9 months period. So obviously the reason for delay is beyond the control of the management. And as on today, even after 1 year, the management is still committed to sell the asset. If these 2 points are satisfied, then even if 1 year condition is failed subsequently, it is okay. Point number 5. It is unlikely that significant changes to the plan will be made for completion of sale or distribution of the asset. What is he trying to say is, as on today, we should not believe that we will reverse ourselves from this plan. So today we have intention to sell, that sale will happen. We do not have any ideas that we may sell, we may not sell, ultimately we will retain the asset and continue using it in our own business. That chance should not be there as on today. Eventually you may not sell also, but as on today that feeling of not selling should not be there. So overall total 5 subconditions are there for the second condition. Number 1, necessary approvals must be obtained. Process to identify buyer must be started. The sale price what you quote should be near to the fair value. The transaction of sale is likely to happen within a span of 1 year from the date of classification. And the last point is the chance of reversal from this idea of selling the asset should not be there at all. If all the 6 conditions are satisfied cumulatively, then your non-current asset is classified as held for sale. Guys, it's very important. On all these points individually questions are there. There is one point which I want to, of course, never tested, but it is a kind of exception to what we study about. See, you purchased suppose there is an old building, sir. Okay. You spent 10 crore rupees and you purchased that building. Your prima facie goal is you buy that building, make some renovations and all, and immediately sell it. So your goal is what? Your goal is to sell the asset only, but it is not your existing asset. You purchased a non-current asset with the intention of selling it. Now, if you observe, if you buy an asset today, and today only if you sell it, why will you get any profit? You will not get any profit. No. Ideally, it's less likely that you get a profit. So my plan is I will buy the asset, I will do some changes to the asset, and then ultimately I will sell the asset. In this case, as on very first day, can I classify it as held for sale? If you observe, first condition itself will be failed. Why first condition will be failed? Because the asset is not available for sale in its immediate present condition. I want to make renovations and all. No. So first condition itself you will fail. The standard says it's okay. None of these conditions need to be satisfied on day one. It is enough if you satisfy these conditions within a span of 3 months from the date of purchase. If today I am buying a building with the intention of selling it, then on the very first day itself, you will call it as classified as held for sale, even if all these conditions are not satisfied on day one. You are given a short period of 3 months. Within that, you can fulfill these conditions, except one condition. That condition is this one. You believe that the sale is going to happen within 1 year from today. So from today, if sale is likely to happen from 1 year, within 1 year, then the remaining conditions, because the standard is saying that I will wait for 3 months, you aram se fulfill the conditions. Such non-current asset or disposal group is classified as held for sale at the acquisition date. The standard provides a short period to meet the classification criteria that do not meet at the acquisition, except the requirement of 1 year. That 1 year requirement definitely you have to satisfy on the very first day itself. Okay, now that the asset is classified as held for sale, now we will move on to the measurement principles. That means an asset which is classified as held for sale, in the books of accounts, how will we measure it? Ind AS 105 ka application mainly is on this one. So there are some steps and all. Let us take an example and we'll go through that example. This step number 1, you will have to determine the carrying amount of the asset on the date of classification. So let us say your all 6 conditions put together, condition 1, condition 2 both put together are satisfied on 1/10/2023. So first step, what we want is, we want on 1/10/2023, what is the carrying amount of the asset by applying all the standards except Ind AS 105. Ind AS 105 application will come in the step number 2. So first determine the carrying amount. Now let's take some numbers, sir. So let's say original cost of the asset is 1000 minus accumulated depreciation till date. Let us say that is 400 rupees. Any accumulated impairment loss. If you have booked any impairment losses in the past, that also you remove. Go and see if there are any indicators for impairment. If there are any indicators for impairment, go into impairment testing now. So let us say some 50 rupees loss I am booking. Step number 1, I got the carrying amount as 450. I presumed that we are applying cost model on the asset. In case you are following revaluation model, you need to revalue the asset to its fair value as on today. If impairment indicators exist as per Ind AS 36, you have to do impairment testing. Any impairment loss is that impairment loss also you have to book as on today. So step number 1, I am determining the carrying amount of the asset by applying all the Ind ASs that are applicable to this standard except Ind AS 105. Step number 2. Initial measurement on classification date. Initial measurement on classification date. On the very first day, how will you measure the asset as per Ind AS 105? The standard gives a small principle like this. asset should be measured at lower of its carrying amount, which in our example is 450, or its FELCTS as on today, fair value less cost to sell. Imagine FELCTS comes to 400 rupees. So lower one is 400 rupees. So asset should be measured at 400 rupees. But asset ka carrying amount in step number 1 came to 450. Therefore, loss is equal to, so from 450 you have to reduce it to 400, loss is 50. Surprisingly, this amount is also called as impairment loss, but this is impairment loss as per IND AS 105. This impairment loss has to be debited to PRL. Sir, but in Ind AS 36 also the treatment is same? No, not exactly. In Ind AS 36 impairment loss, you have any revaluation surplus, you will first adjust the impairment loss to such revaluation surplus, and after exhausting the revaluation surplus, then only you will hit your P&L account. But here the situation is not like that. Even though you are having revaluation surplus, this impairment loss of Ind AS 105, this will not go to revaluation surplus. It must be debited to your PRL. Directly put it in P&L account. Sir, what if FELCTS is not 400, let us say it is some 480. In that case, 450 or 480, whichever is lower low, 450 will get selected. You will not have any gain. Okay, so gain recognition is not permitted in step number 2. Either you will get loss or you will have the same amount as your step number 1. So 450, you booked impairment loss of Ind AS 105, so it became 400. Now remember, hereafter no depreciation or amortization. You will stop providing depreciation as per Ind AS 16 PP standard. If it is an intangible asset, you will not do any more amortization hereafter. Those days are over. Once you come into Ind AS 105, step number 2 you apply. Gone Ind AS 16, Ind AS 38. Nothing will apply for it further. Step number 2. You are still standing on the same day, 1/10/23. 1st October 23 you are standing. Measurement on first balance sheet date, which is 31st March 24. So it has been 6 months you classified the asset as held for sale. Next 6 months the asset could not be sold. In that case, in the balance sheet, at what amount will you show? Since you stopped providing depreciation, the carrying amount of the asset will be 400 only. Natural. What our standard says is, compare the carrying amount with its FELCTS as on today. Suppose the FELCTS of this asset as on today, example, sir, if it is 370. So it's, if I sell it effectively, I'll get on 370, but in my books I'm showing that this at 400 right now. So that last 300 rupees again you have to book. A loss you have to book it in P&L account, reduce the value of the asset by 30 rupees to make it to 370. This is easy case. Let us take 520. So when I compare my carrying amount with FELCTS on the balance sheet date, FELCTS is higher, therefore there is a gain of 120. Now the question is, can I recognize the gain? The standard says you can recognize the gain to the extent of accumulated impairment loss till date. So gain can be recognized. When you say accumulated impairment loss till date, it means the impairment loss you provided before step number 1, in step number 1, and in step number 2. Step number 1, impairment indicator is there, so you provided 50. Even before classification, once upon a time you booked impairment loss of 100. Step number 2, you booked another impairment loss of 50. So total 100, 50 and 50. So total you can reverse an amount up to 200. The maximum you can recognize is up to 200. But your gain is only 120. Gain 120 is recognized in PRL, and the revised carrying amount of the asset is 400 plus you are booking again and increasing the value of the asset, it is becoming 522. Is step number 3. Let's move on to step number 4. Next balance sheet date. Next balance sheet date can be any quarter balance sheet date, any half yearly balance sheet date, or for that matter next year as well. So let us say I am directly going to next year, 31st March 25. Now if you observe closely, on 1/10/23 you classified the asset as held for sale. 1 year is over, the asset is not yet sold. Since the asset is not yet sold, this is violation of one of the condition of your classification itself. That is, the sale must be completed within 1 year. But sale could not be completed. Assume that this is because of the reasons beyond the control of the management, and the management is still committed to sell the asset. Therefore, you can continue applying Ind AS 105. Sir, on this date, what will happen? On every balance sheet date, the principal is same. Principal, there is no change. So, take the carrying amount of the asset, which is 520. Compare this carrying amount with this FELCTS of the asset. Imagine FELCTS of the asset is 700. Therefore, apparently gain visible is 180. Now, the question is, can I recognize 180 rupees gain? The answer is no. The reason why you cannot book 180 rupees gain is, you can maximum recognize gain to the extent of accumulated impairment loss, and your accumulated impairment loss came to 200 rupees, out of which 120 rupees you already booked off on the last balance sheet date. So, as on today, you have scope to book another 80 rupees. Recognize. Maximum 200, 120 already enjoyed, so another 80 you can recognize and ignore 120, sorry, the remaining 100. This gain you will recognize in PR. Therefore, whatever is the revised carrying amount, that would be 520 already there plus 80 you are booking, so 600 is your revised carrying amount. Subsequently, one day you will sell the asset. When you sell the asset, whatever difference is there between the 600 rupees and your sale price, that is gain or loss on sale, directly that will go to PRL. That's all, sir. So all you have to remember is just 2 points. Step number 1, first to arrive at the carrying amount of the non-current asset correctly. Don't apply Ind AS 105 rule, but apply all the other standards that are applicable. In case your asset is measured at revaluation model, in step number 1, you have to revalue the asset also. Step number 2, initial measurement. Initial measurement is compare carrying amount with FELCTS and measure the asset at lower of these two. So gain is impossible, loss can come, and that loss is also called as impairment loss, but this is not impairment loss as per Ind AS 36, it is impairment loss as per Ind AS 105. It is as good as loss on sale only. Therefore, you have to book it directly in PRL. It will not be adjusted into revaluation surplus, even though you have a positive revaluation reserve for this particular asset. Next, on the very first balance sheet date, measurement classification date, we used the terms compare carrying amount or FELCTS, whichever is lower. Now we are not using the word whichever is lower. We are saying that compare the carrying amount with the FELCTS. If it is loss, book the loss. If it is gain, book the gain to the extent of accumulated impairment loss till date. If the asset is still unsold for next balance sheet date also, then also repeat. Again, compare carrying amount, compare with the FELCTS. Loss is there, book loss. If gain is there, book gain to the extent of accumulated impairment loss till date. That's it. One day you will actually sell the asset, whatever gain or loss is there, directly it will hit into your P&L account. Khatam, game over. So guys, this is about your treatments. All these steps properly I have given here, step by step. There is one example also. Example, similar numbers, same numbers more or less. Next, what if I am having a disposal group held for sale? Steps are similar, but you should be careful. So you have a disposal group held for sale. Let us say in my disposal group, I have goodwill, I have plant and machinery, I have building, I have investments, I have inventories. So 5 players are there in my disposal group. In this, so let's directly, steps are same, sir. Steps are same. Let's apply step number 1. What is step number 1? You will determine the carrying amount on classification date. So let's say goodwill is having an amount of 500. Plant is having a carrying amount of 3000. This is having an amount of 2000. This is having an amount of 1500. This is having an amount of 1000. This is almost 3000, 5000, 6000, 8000 rupees. So step number 1, in case of individual asset, you just work out the carrying amount of that particular non-current asset, but this time you have to work out the carrying amount of the entire disposal group. So here in your disposal group, this is a scoped out item. This also is a scoped out item. They will just be there as a part of the group. They will help you to determine the amount of losses and gains, but you will not apply any Ind AS 105 principles to those assets. There are respective standards which will take care of the impairment in those assets. You do not worry about that right now. So come to step number 2. You will measure this at lower of carrying amount and FELCTs. So let us say carrying amount is anyway 8000. Let us say this is 6500 rupees. So whichever is lower, 6500 got selected. Therefore, impairment loss as per Ind AS 105 is 1500 rupees. Now the question is, who will eat this 1500 rupees? See sir, this is just like your impairment loss allocation in the case of a CGU. So whatever loss is there in a CGU, that loss must be allocated to all the assets in the CGU in the ratio of their carrying amounts, right? So same principle. Only thing is, don't touch these two. They are not in the syllabus of Ind AS 105. There's some other standard that's applicable, so don't allocate impairment loss to these two. So you have to allocate this 1500 impairment loss only to these 3 scoped in items. But out of these 3 also, you have your best friend goodwill. So this goodwill is an unverifiable, unidentifiable asset in the balance sheet. So whenever you get a chance, first knock off goodwill. So out of this 1500, 500 rupees will be first directly adjusted towards goodwill. Remaining impairment loss of 1000 will be allocated to plant and building proportionately in the ratio of their carrying amounts. So it will look like this now. Goodwill 500 was there. You have plant 3000, building 2000, you have investments, you have inventory 10,000. This is 8000. You now have an impairment loss of 1500 to be allocated. This 1500 don't touch these two. If 1500 loss will be first allocated towards goodwill to the extent available. Remaining 1000 is allocated to plant and building proportionately 3:2. So that is 600 and 400. So the revised carrying amounts are now 0. This is 2400. This is 1600. This 1500 and 1000. So this is the story after applying your step number 2. Now come to step number 3. First balance sheet date. When you come to your first balance sheet date, our rule is what? Take the carrying amount, compare that with your FELCTS. If there is a loss, life is very simple, just book the loss, reduce the carrying amount of scoped in items proportionately. If there is a gain, you can recognize gain to the extent of accumulated impairment losses till date. That's a rule. Same thing here also. Now, if it is a single non-current asset, whatever carrying amount you determine in step number 2, that carrying amount only will be there for the subsequent balance sheet date also, because you will not provide any depreciation amortization. But now we are not talking about a single non-current asset, we are talking about a disposal group, and in disposal group there are some scoped out items also, like your investments, inventory and all. For that other standards will apply. When other standards will apply on 31st March 2024, when you are standing, the carrying amount of investment and inventory can be different right now. They can be different right now. So you have to rework the carrying amount again. You cannot presume that today's carrying amount will be same carrying amount as it was there on the last classification date. It need not be same. The numbers can change because of your scoped out items. If it is single non-current asset, the amount will be same. And even in this DG also, the amounts for these three will be same. But these two numbers need not be same. They can be different also right now. So you should be very careful with that. So anyway, let me just work out. Goodwill is 0. Plant is appearing at 2400. Building is appearing at 1600. Investment, let us say this is an investment in equity shares on which FATPL is getting applied. So last time it is 1500. This time let's say it is 2000. Inventory, let us say it's cost or NR, whichever is lower, cost only is getting selected 1000. So this becomes 7000 rupees. So this is the carrying amount, sir, 7000. You have to rework this again or recheck. If nothing is given in the question, then we don't have any option. You have to assume that 6500 only is the carrying amount as on today also, but amounts can change, sir. Should be a little careful. This you compare it with FELCTS. Suppose FELCTS of this group right now is, let us say, 7500 rupees. Therefore, there is a gain. If there is a loss, life is very simple. You just allocate the loss to plant and building. But this time you are having a gain. Now the question is, can I recognize the gain? The answer is yes. You can recognize the gain to the extent of accumulated impairment loss till date. In the given question, we booked impairment loss of total 1500. In that 1500, 500 rupees went to kill goodwill. You cannot anyway restore that. Ignore that. So another 1000 rupees you allocated towards plant and building. Since the loss allocated is 1000, accumulated impairment loss till date is 1000, this is within that only 500 rupees. If 500 rupees, you can now recognize it as a gain. 500 rupees, and this 500 rupees you allocate it in the ratio of 3:2 towards plant and building. This cannot be recreated. These two are don't touch me. You can recognize gain like this. If it is a loss, then again you will repeat the same thing whatever you did on the last balance sheet date. Ultimately, one day you will sell it off, then entire carrying amount versus sale proceeds will be transferred to P&L account as a gain or a loss. Khatam, sir. This is about your non-current assets classified as held for sale. In this measurement principles, one important point is that is change in the plan from held for sale. So that means you classified a non-current asset or a DG as held for sale. You applied the measurement principles of Ind AS 105, but subsequently you reversed your decision. Day one you never anticipated that, but subsequently you have changed your decision to sell the asset, or you have crossed the period of 1 year and you are no more committed to sell the asset. In these cases, what accounting you have to do? Because you stopped providing depreciation, you brought in FELCTS measurements and all, which otherwise you would not have done for your PP and intangible assets. But today what you have to do? Listen, the rule is very, very easy, guys. It is just like impairment loss reversal in India is 36. Carrying amount of the asset should be remeasured to lower of deemed carrying amount if Ind AS 105 is not applied. The recoverable amount as on today. Suppose your existing carrying amount after applying Ind AS 105 for so many years is some X amount. That X amount has to be updated, either increased or decreased to the deemed carrying amount of the asset. If Ind AS 105 was not applied, had it simply provided depreciation, and if indicators are there impairment, then today what amount would have been that? At the same time, I should ensure that you should not exceed your recoverable amount as of today. So that between these two, whichever is lower, you select. So from your existing carrying amount, after applying Ind AS 105, you update the value of the asset to this number, the lower of these two. That may result into either increase in the value of the asset or decrease in the value of the asset. Any which way you do it, corresponding impact to give it to your PRL account. That's it. Special points are, for example, on the balance sheet date, the asset is not classified as held for sale, but after the balance sheet date, but before approval of financial statement, the asset is classified as held for sale. Can I call it as adjusting or non-adjusting event? The answer is non-adjusting event. So you simply have to give a disclosure. Next, there is another point. It's a conceptually good one, and knowing this will help you when you see some questions also. So look at this, ma'am. There is a company A Limited. A Limited has 80% holding in another company called B Limited, which apparently becomes its subsidiary. Since it is a subsidiary, A Limited prepares consolidated financial statements, and in the consolidated financial statements, as you know, you will have assets of A Limited plus assets of B Limited. You will have liabilities of A Limited plus liabilities of B Limited. You will consolidate. Of course, goodwill and all will be there. It's okay. NCA also will. All this okay. Now, our A Limited has committed to a plan to sell the investment in B Limited to an extent where control is lost on B Limited. We did not actually sell the investment. If I actually sold the investment, that fellow is not my subsidiary. Why will I do consolidation? So I haven't sold it yet, but I want to sell it. I am committed. All my conditions are satisfied. Since all the conditions are satisfied and all, even though today it is my subsidiary, today I have prepared consolidated financial statements. In future, the moment I dispose of this investment and I lose control over my subsidiary, then I will not be doing consolidation. With one event of sale of investment in the subsidiary to an extent where I lose my control, what will happen is this part, and this part is going to disappear. What our standard says is, today in your balance sheet, certain assets and liabilities are there. In a single transaction, this chunk of net assets is going to vanish off from your balance sheet. And since it's very likely that you are going to sell the investment, this particular, this one, and this one qualifies as disposal group held for sale. So the assets and liabilities of subsidiary which are present in your balance sheet as on today, they suddenly today becomes a disposal group classified as held for sale because you have intention to sell off the investment in the subsidiary. It may also satisfy the definition of discontinued operation. for which extra disclosure also has to be given. The discontinued operation, we did not discuss it yet, but prima facie, definitely this is a DG held for sale if it is representing a major component of your business. If it is representing a major geographical area of your operations, then apart from DG held for sale, it also qualifies as discontinued operation also. So whether it is a DCO or not, I do not know. It depends on what is the size of that component, the subsidiary B. But definitely this is a DG held for sale. See, in our Schedule 3 Division 2 balance sheet, we have this classification as non-current assets, current assets. So non-current illiquid assets, top level we will show. Current assets, liquid assets we will show in the bottom part. But we are talking about non-current assets which are held for sale. Recently in CA Inter examination also there has been an MCQ. When non-current assets are held for sale, how will you classify it? Will you call it as non-current or current now? So under Schedule 3 Division 1, we don't have anything separate standard called as non-current assets held for sale. So when a non-current asset is held for sale, if the sale is expected to happen within the next 12 months, we will go and classify it as current asset only. But under Ind AS, for which Schedule 3 Division 2 is applicable, you have to apply Ind AS now. So under Ind AS, you have a separate heading carved out for you. Non-current assets or DG held for sale, separate heading is there. So non-current assets, current assets, below that one more heading you create. Whatever plant and machinery building you want to dispose it of, show them separately under this heading called as non-current assets held for sale. Similarly, in your disposal group, if there are any liabilities, separate them from other liabilities, give it a separate category. Some of the assets which you want to sell off, non-current assets or DG held for sale, relating to those assets, if you are having any reserves like a revaluation surplus, separate that from other equity, show it separately. So apart from your non-current assets and current assets, there is a third category also, which is held for sale category. The Schedule 3 format, if you see, it is not there, but the standard is asking you to create another section in your balance sheet. Schedule 3 is okay for that. So guys, this is all our discussion on non-current asset held for sale. Now what is left is a small concept of discontinued operation. Discontinued operation means, look at this, sir, you are doing multiple businesses, various kind of businesses. You are into food processing, you are into manufacturing of cosmetics, you are into manufacturing of footwear. So many businesses you are doing under a single company name. So when you look at your P&L account, you will have a single amount revenue, sales, you will have single amount costs. Of course, separate into various heads like employee benefits, depreciation, finance cost and all, but you will show a single amount. So profit also will be only for that single amount, right? So your P&L account basically represents so many businesses combined result. Suppose in the current year, you decided to discontinue a particular business. You stop doing a particular business during the current year. So from next year onwards, in your P&L account, the revenue components and the cost components of this particular business will not be included anymore. So in future, it is quite possible that your revenue, your expenses and your profits will change because of this discontinued operation. So our reader of financial statements should very clearly know that in your P&L account, how much revenues and expenses belong to continued operations, how much do they belong to discontinued operations, so that for projection purposes and all, people will consider only the continuing operations ka column and ignore the discontinuing operations ka data for future projections. So the concept is all here about simple presentation in your financial statement. So if you are having any discontinued operation, or discontinued operations ka revenue, discontinued operation ka expenses, discontinued operation ka profits, don't include in your main P&L account. Prepare a separate statement, work out that profit of discontinued operations separately. That number alone you bring it to the main P&L account and add it to profit from continuing operations. So from your main P&L account, we will eliminate all the incomes and expenses related to discontinued operation, and the discontinued operation ka profit or loss alone is brought as a single amount into your P&L account. That's all is required under the standard, sir. But formally definition we will see. It's important. Discontinued operation is a component of an entity that either has been disposed of, you already sold off in the current year, that is also a discontinued operation, or it is not sold off but it is classified as held for sale. The moment you use the word held for sale, that non-current assets held for sale points and all, or DG held for sale points and all, they are all applicable here now if you are having any non-current assets. And not only this, it's classified as held for sale and it represents a major. It represents a major line of business or geographical area of operations. You are doing business in 4 different areas in the country. Each area contributes to around 20 to 30% of your revenue. So all the 4 locations are important locations. You are doing one business only but in multiple locations. One of the location you decided to discontinue. That's all, it becomes a DCO. So because it's a major geographical area of operations. Major does not mean it should not be more than 50% or not. Here the intention is it should be significant. That's enough. You are doing multiple businesses. One business vertical you decided to drop in the current year. So this is also a major line of business you are stopping. Therefore, it becomes a discontinued operation. And if you have any subsidiary which is acquired exclusively with a view to resell, then that subsidiary also must be treated as a discontinued operation. A component of an entity comprises operations and cash flows that can be clearly distinguished operationally and for financial reporting purposes from the rest of the entity. In other words, a component of the entity will be a CGU or a group of CGUs while being held for usage. So, had you not sold this, had you not decided to discontinue this, then this thing should represent at least a CGU or at least a group of CGUs. It should be some business representation or it should represent a major area of your geographical operations. So, this is the definition of discontinued operation. Now, what you have to disclose? See, on the P&L account, you will show a single amount, sir, profit or loss from discontinued operation. Suppose you are into 3 products, A, B, C, 3 different products. You decided to discontinue C in the current year. So, in your P&L account, sales, expenses, profit and all should be only for A and B, A and B, A and B, A and B. But C business, even though you discontinued it in the current year, for some period at least you might have done business C. So, business C related revenues, expenses, profits, tax, everything you do it in a separate statement. A single number alone you should bring it. Suppose, since you decided to discontinue C assets and liabilities will be sold now. So, in that assets there can be some non-current assets also. On that non-current assets held for sale ka provisions what we discussed till now is applicable. That gain or loss also has to be booked in P&L. That also you include it in that single amount only. Discontinued operations ka profit or loss you are computing separately. No, in that only include this measurement losses also, because on the classification date, on the balance sheet date, gain or losses are possible. So that loss also must be included. Club them, show a single amount. Revenues, expenses of discontinued operations. When you apply non-current asset or DG held for sale rules, some gains and losses will be there. This plus that, both you club single amount, bring it to the main P&L account. On the face of statement of profit and loss account, a single amount must be shown, combining post-tax profit or loss from discontinued operation and gain or loss on remeasurement of non-current asset or DG held for sale. And then how you got this profit or loss, means what are the revenues, expenses and all, and what is the amount of remeasurement losses or gain on the classification date, on the balance sheet date applying in days 105. For that you prepare a separate additional statement, or you can also give it in your notes to accounts. In this you will show revenue, expenses, pre-tax profit and all, gain or loss on application of India's 105 classification as held for sale principles, and any related income tax expenses and all, means tax effects, all that you have to show. Last year you were doing business C also. Last year P&L account, if I see, sales were of A also, B also, C also. But current year P&L account sales will be only for A and B because C you have discontinued. So you eliminated that from your P&L account. A single amount only you are bringing. So comparative column also must be restated. So last year P&L as it is, you should not copy paste in the comparative column of the current year. You eliminate C from last year data also. Comparative column also should be given only for A and B. C amount, single amount should be shown even in the last year also. Even though in last year segment C or business C is a continuing operation or was a continuing operation. So previous year's figures must be represented. They are using the word represented because the word restated you will use only when there is a change in accounting policy, when there is an error and all. Since there is nothing of that sort is there, you better use the word represented. Last year column is represented to eliminate the impact of discontinued operation shown as a single item. Next, EPS also has to be presented separately. You have to show EPS for continuing operations separately, EPS for discontinued operations separately. You cannot, of course, all operations also you have to give. Finally, the following is not a discontinued operation. Suppose, sir, you are having 3 businesses. One business sales have significantly fallen down in a particular year. In your board of directors meeting, one of the directors suggested that we should discontinue this business, we will only suffer losses in future. But remaining people did not agree. So we waited for 1 more year. Further sales reduced, more loss has come. This time 2 more directors argued that we should close, but remaining directors did not agree, so we continued the business. In 3rd year also we got a loss in this business. So now people are thinking to shut down this particular business among so many businesses what we have. Now, this business C, which is giving a loss in 1st year, 2nd year, at that time there was a discussion of discontinuance, but we never actually decided to discontinue the business. We took a coordinated decision, a consolidated decision to discontinue only in the 3rd year. So just because your sale of a particular product is decreasing each year, that does not mean that this is a discontinued operation unless you decide to discontinue. Sir, continuously if you are suffering losses, continuously if your sales are falling down, eventually the business has to be discontinued anyway. But that does not mean that a fall in the sales automatically makes it a DCO as on today. Till that conscious coordinated decision is not taken, there is no discontinued operation. Change in product mix. See, for example, I am having a mobile, my company is into manufacturing of 2 kinds of mobile. One is GSM, where you can put a SIM card of any network service provider, you can use a phone. Then I am also doing CDMA phones. CDMA phones means it comes with an inbuilt operator, like Jio ka phones will be there where you can use only Jio. Once upon a time Tata Indicom used to come, where you can use only that network service provider. You cannot change various network service providers. So whatever network service provider has sold you the instrument, that instrument only, provider only you have to continue. So I am manufacturing 2 kind of mobile phones. But over a period, people want flexibility and choice. So nobody is buying this CDMA mobiles because the choice is restricted. You have to stick to only one service provider. So over a period, what happened is I decreased the manufacture of this CDMA mobiles and I increased the manufacture of general SIM mobiles. So I discontinued one product and I increased the production of another product. So technically, did you discontinue manufacturing CDMA mobile? The answer is yes. Sir, are you a discontinuing operation? No. No. Just because I stop a particular product does not mean that I am discontinuing my business. Sir, in my business, I will be selling a variety of products. One product picks up a demand, I produce more of that. One product is losing demand, I sell less of that. So change in product mix is not a discontinued operation. Next. Earlier we discussed A, B, C, 3 processes are there. In that A process, if I manufacture some raw material, it's coming to 140 rupees. So I stopped doing that. I started buying the product from the market at a cheaper rate. So I stopped a particular process because it's becoming costlier, or I find a better quality material outside. That does not mean that you are discontinuing your business or discontinuing an area of operations. You are discontinuing a process. Discontinuing a process, discontinuing a product does not mean that you are a discontinuing operation. Similarly, you shut down operations in one area and you relocate to another area. That means you are migrating from one area to another area. Technically, we may say that in general common parallel language, layman's point of view, we can say that, sir, we discontinued business here, we started there. That is okay. The word discontinue is correct only in layman language. But we are not layman, no sir, we are pro, counting pro. So that is not a discontinuing operation for the purpose of Ind AS 105, because this is a relocation. You stop it there, you are starting in some other location. Relocation of business does not mean it is a discontinued operation. So guys, that's all about your Ind AS 105. which deals with non-current assets held for sale and discontinued operations. So I'll give you a video of some few selected questions covering all the principles what we studied across different asset related standards. Important questions, some 2 or 3 questions from each indices, like that we will try to make a video on all the 6-7 standards whatever we have concluded till now. Thank you so much guys. Prepare well. All the very best.